Okay. Good morning. Welcome back for day 2 at TiECon Delhi-NCR. Fortunately, the traffic on Delhi-Gurgaon expressway, which threatened to be bad, wasn't, and people made it on time. I must also say, our decision to hold this event at Leela Ambience is absolutely justified, and that's one reason why we have so much energy and crowd, because clearly this is TiECon Delhi-NCR and not just Delhi, and therefore being closer to the center of gravity in Gurgaon was so important, and I hope you agree with the decision. I want to talk about, all of you have had great stories from yesterday, but my favorite story from last evening was my interaction with this young entrepreneur called Aditya Arora. He was telling me that in 2015 at the TiECon, he was a volunteer along with 20 other students from Shahid Sukhdev College of Delhi. At that TiECon, when he was a volunteer, he said it was a transformative experience. He's become an entrepreneur. Today, he's a VC with a fund of 300 crores. So 8 years of TiECon have transformed him from a student volunteer to a 300 crore VC. That to me is the magic of TiECon Delhi-NCR and what TiECon hope to do for the entrepreneurship world. So very quickly, 3 things I want to do before I hand over to Prashant and Shuchi. 3 nuggets. One is, during the years of COVID, all of us were witness to those interesting media headlines where there was literally a tug of war about, is Delhi-NCR the startup capital or Bangalore? Folks down in Bangalore were clearly not happy with the debate even being initiated. But for all of us, it was reaffirmation that Delhi-NCR is in contention for being the top spot in the startup leaderboard. So I think we deserve to give ourselves a pat on the back for taking Delhi-NCR there. So 3 cheers to everyone in this room. So Delhi-NCR has done so well. I want to talk back to my second bit today. In 2019, TiE Delhi-NCR created a report called How to Turbocharge the Startup Ecosystem in NCR. And I want to thank folks from Cisco, Microsoft, Google, Shruti, Latika, Apurva, and of course Rajan for helping that report happen. But there are a few big recommendations that still hold true today in 2023. One was that Delhi-NCR needs visible startup hubs and incubators of the kind that T-Hub has in Hyderabad. We don't have that, and that becomes a magnet for talent, and that's missing. I hope collectively we can make that happen. Second was how to increase the talent base, especially on the tech side in this region. That's what gives Bangalore its competitive edge. Can we do that? And third, we need a lot more of early stage and seed investment here. 3 recommendations hold true, and we should collectively make this happen to take Delhi-NCR right on top. My final theme is something I borrowed from a book I was reading recently. It's called Making India Great Again. Till the Middle Ages, India was about 25% of the world GDP till we somewhere lost our way. While there were many reasons why we declined, but this book points out one interesting reason. It says we lost our competitive edge because Indian craftsmen, who are otherwise fantastic, exporting to the world, they were working in silos, in isolation. There was no collective learning or sharing. So today, as India is once again on an upward trajectory, all of us in this room at TiE and at TiECon, we need to make sure that we don't repeat that mistake. Our learning and sharing that we've seen since last evening continues, and we continue to retain a strong competitive edge. And I know, looking at the buzz of this room, we're not going to let India go through the same thing again. So Aditya Arora, the entrepreneur about whom I spoke at the beginning, is a great example of how our collective efforts can ensure that the next generation of entrepreneurs come alive and contribute. So let's wish ourselves good luck. Have a great day, and thank you once again for being here. I'd like to invite Prashant and Shuchi.
Hello. Hello.
So exactly 1 year, 22 days ago, Russia decided to invade Ukraine. 1 year ago, cotton hit the second highest prices ever in a 110-year history. 1 month and 18 days ago, the US Fed raised interest rates yet again, and that was not interesting. What was interesting is, since the 80s, this is the highest growth rate curve on interest rates. We went, or the US went, from 0 to 4.5 with a target of 5% in less than a year. Unprecedented. And then 7 days ago, SVP folds, and 3 days ago, Credit Suisse announces that, hey, you know what? Accounting's not so cool when I look back 2 years. And then their largest shareholder decides not to invest further. And in the middle of all of this, I go and merge LimeRoad into a publicly listed entity with 10 years of public history. That's 4 months and 6 days ago. 1 month ago, IMF says, hey, you know what? The thesis on India, deep India, which actually was predicating my decision to go offline and online in value fashion, holds. IMF came out and said, hey, you know what? This is going to grow at 6.8% and continue to do so. And then a week ago, we had G20 presidentship and we hosted the world. What a crazy year. And crazy is what I love. And you know why I love crazy? Because this combination of opportunity and complete uncertainty is the boilerplate for success. It is the platform when entrepreneurs and businesses really put down their heads and build businesses actually create greatness. I love it so much more than those worlds of frenzy when everybody believes in immortality and everybody drinks their own Kool-Aid. So, ladies and gentlemen, it's lovely to see you this morning. Thrive and survive are the two keywords which forms the basis of the next 7.5 hours that you will spend here today. So I have only one call to all of you. Drink from the hose. Today you will hear so much. Absorb authentically. Smile. Turn left. Look at your person to your left and say hello. And then turn right and do the same. And smile, engage, absorb, and we're here to have conversation. Welcome to TiECon.
Yes, as Suji already put it very eloquently, we live in the most interesting times most of us have been through. It's a very opportune time to have a conference like this, when clearly what we see is a lot of chaos and a lot of mixed messages we are all getting. How do we filter that down? What exactly is going on? Is it the best of times? Is it the worst of times? Or is it both? The answer, of course, seems to be it's both, depending on where your vantage point and what you see at that point in time. Having said that, I think a few things are very, very clear. One, India is on the rise and is one spot in an otherwise very gloomy, turbulent world where we are seeing strong macro winds behind our backs. I had heard it at one of the conferences, and there are a bunch of industry reports that talk about it. We are on track to be a 30 to 40 trillion economy by 2050. And it's not absurd to imagine that. It's pretty much continuing to grow at 5 to 7 to 8% year on year, and let compounding play, which is not easy, but where we are today, it's very, very eminently doable and possible. And what does that mean if you put it in perspective? That 90% of that value creation is yet to happen, which many of the people here, especially people in their 20s and 30s, will be the architects of building. That's only 10% of that is the size of the economy today. And that is the big macro picture. India is continuing to be on the rise. India is very well positioned in an otherwise turbulent world. Cut to short term, there's a lot of chaos. Chaos is where entrepreneurs thrive, as Suchi said, and that's the opportunity. We do have a tough phase from the startup ecosystem this year. Probably next year, the best time to build the business the right way, set your fundamentals right, etc., etc. Now, while we were designing TiECon this year, the core theme we wanted to look at was how do we demystify the situation and just make it simple for people to understand what are the challenges, realize the opportunity, what should you do right now. I think there's no better time to be an entrepreneur. This is a great time because businesses of real value are getting built. That's one part, and that's where the second part of our conference today, the second half, would feature on building for Bharat, building from India for the world, the opportunities thrown up by the geopolitical global situation, all of that. The first half of the conference is talking a lot more about the challenges we all foresee, how to get your cash equation right, how to deal with an uncertain financing ecosystem. The capital markets are tight and will continue to be for some time. How do we navigate all of those situations? So that's extremely, extremely important. So please do make the most of it. The other part that we were very clear is that the lot of, or in fact, more of the value of these groups coming together is actually in the non-formal sessions, the networking sessions. And this time, as a key part of the conference, we wanted to keep interaction center stage. So a lot of, when you go through the agenda, the schedules, you'll find a full run of networking related activities. These are curated events, curated very, very nicely by highly specialized teams. That the objective is that you get to actually get maximum value from your peers, from people in the ecosystem, from people that you will engage with in this conference, more than just sitting out and saying hello to anyone and exchanging cards. So please make the most of that opportunity as well. It's our endeavor to make it a very interactive, a very high value conference, so that when you go back with specific things that were interesting, that change or built perspective, and then specific connections and specific conversations that help you think through how do I maximize this opportunity, how do I contribute to this ecosystem and enjoy what will be a fruitful next 20, 30 years to be in the country that you need to be, the right place, right time. So we can all congratulate ourselves that we are very lucky to be where we are today. Having said that, it's never easy. It's never going to be simple because the wind is behind our back. That means it's behind everyone's back. So your competition is also enjoying that. Having said that, we have the opportunity and there's no doubt about that. So with that, I would like to welcome you all to TiECon NCR 2023. Hope you have a great day and look forward to interacting with you more as we go along. Thank you. Now just continuing with the macro topic, the big themes. This is the G20 year, and we are extremely fortunate to have amidst us our star keynote speaker for the day, Mr. Amitabh Kant, the Sherpa for G20. Amitabh, may I welcome you to please join me on the stage. So, before we get into the specific conversation, could I get a mic, please? Yeah. As the mic comes along, let me just first narrate my personal story of meeting Mr. Kant for the first time. That was 2016. He had just taken charge from Secretary DIPP, where the Startup India movement was born. So, of course, he initiated the startup movement from the government side of things in a very organized way. And we were facing few challenges related to our business, and this was a Friday afternoon when I wrote a random cold email that would love to meet you, need some help regarding the startup that we are running. I got a mail immediately, and I was you would not remember it, of course, but as an entrepreneur, it's a big thing. Saturday evening, 6 p.m. come to office, and I was shocked for multiple reasons. One, that was too quick a response to be coming from a person. I thought somebody else must be reading the emails, filtering emails, bringing agenda every Monday morning to the table or something. It was real time. The other thing is Saturday evening, 6 p.m. in a government office. What's going on? Like, who does that? And that to me was, and after getting there was, what is it? How can I do? What can I do to help you? And followed by immediate follow-up action. So, as a startup ecosystem, I think people who've been around, we are extremely grateful, sir, for having you steward this entire movement. And I would like to start by just asking you, what about startups? What about this startup agenda that gives you all the enthusiasm, motivation, energy, and that you basically stepped forward to create this movement in India? So just your thoughts on what is it that's exciting about this world?
Prashant, when we started the Startup India movement, and I still remember January 2016 when Prime Minister launched it, it was the first time we were putting only the startups on the dais, and Suji was there with the Prime Minister. There were just 452 startups in India at that point of time. Today we have over 90,000 startups, we have over 110 unicorns. And we've been able to build the third best ecosystem in the world. And I'm quite sure that what we've done is a phenomenal journey it's been. Just look at this. When we started, there were, the process of identities had just begun. We've been able to build digital identity for over 1.4 billion people. And, then between that period, if you look at it, between 2016 and 2018, we opened up about close to 500 million bank accounts. And then we seeded all these bank accounts with both your digital identity, that's your Aadhaar and your mobile number. And then the process of expanding on the mobile. So we've seen about 950 million Indians now having close to almost 1 billion people having a smartphone. So, if you look at it, during this period, I have my debit credit card, I've not been to a physical bank, I've not been to an ATM machine. For me, my mobile is my virtual bank, and I do all my transactions from here. So what India has demonstrated is that we've been able to do open source, we've been able to do open APIs, we've been able to do interoperability. We built a public track on top of which the private sector has innovated. And we are the only country where PhonePe competes with Google Pay, WhatsApp competes with Paytm. There are 40 different apps competing in the marketplace. But the remarkable journey has been that you've seen payments, digital fast payments. But then you had also a number of startups who started doing digital lending, which was all paperless. So if you look at Pine Lab, lending card, you look at MobiQuick, they've all done digital lending. And then you had a whole set of new startups, Zerodha, Grow, Upstock, creating huge amount of wealth in the market. I mean, Zerodha controlling about almost close to 28% of the wealth management stock market in India. One young startup. Look at the kind of wealth management that has been done in India. You've opened up to tier 2, tier 3 cities. And then you had another set of startups like insurance, end-to-end underwriting of insurance. So Digit and Acco, look at them. When I was buying my insurance policies, it used to take us 5 to 6 months to get an insurance policy from LIC. These guys give you insurance policy in 2 minutes, all digital. So what a transformational journey from identity to bank accounts, to payments, to credit, to wealth management, to insurance. I mean, it's been a phenomenal journey of transformation for India. And that's why, to my mind, India is unstoppable because of startups and because of the phenomenal energy, vibrancy, and dynamism they bring. So what we've done in India, nobody else in the world has ever done before. And it's important to understand this because in the world there are 4 billion people who do not have a digital identity. 4 billion people. There are 2.5 billion people who do not have a bank account. There are 133 countries which do not have a digital fast payment. And I think no country in the world today has wealth management of the kind or insurance policies of the kind that we are generating. So your market is not India, your market is the world. Your market, your ability to take what you've achieved in India to the rest of the world and capture that market. And therefore your market is not the 1.4 billion people of India, it's the market of the next 4.5, 5 billion people who are moving to the middle class and the rest of the world. And therefore, this energy which you are demonstrating today in India actually needs to be taken out and taken to the rest of the world. And that is what we need to ride. The Indian model is a unique model and it's a phenomenal model. And if it has to penetrate the rest of the world, only the startups can do.
Phenomenal. So, sir, for the first time, startup is also on the G20 agenda. And Startup 20 is one of the key pillars of the G20 agenda. What do we look forward from this specific initiative? What do we see? The world can benefit a lot from the learnings from both the public side and the private side. How does the G20 come into the picture, and specifically with respect to the Startup 20 agenda?
So this is the first time, in India's presidency, we've actually started an engagement group called the Startup 20. And this is being driven by the Atal Innovation Mission right now, and with a number of other startups. There are many startups involved in this. And actually, they've done a meeting in Hyderabad. They're doing one in Sikkim right now. But the important reason why we've started this Startup 20 is because the Indian model is unique. If you look at the last 2.5 decades, world over, all over, the innovation that has happened, it's all been driven in the last 2.5 decades by the big tech. It's been driven by Google, it's been driven by Apple, it's been driven by Microsoft, and it's been driven by Meta and or Amazon in USA, and it's been driven by Tencent and Alibaba in China. So you have the big tech model in the United States, and you have the GDPR model in Europe. The GDPR model, actually, Europe was very concerned about privacy issues, and therefore they focused on privacy at the cost of innovation. And actually, Europe has not seen much innovation happening in the last 2.5 decades on the digital tech model. But the big tech model grew because they were able to access citizens' data. And yours data, my data, every data is being used for artificial intelligence, machine learning, mining, and so on. So all innovations that have happened, IoT, cloud, everything that has happened, AI, all that has happened is because of yours and my data with the big techs. In sharp contrast to this, India built a very different model. India built a model of railway tracks on which we allowed private sector to innovate and compete. We built up a model of open source, open APIs, and interoperability. And therefore, our view is that what India has demonstrated is, population scale model at very low cost. And we've demonstrated that the cost of acquisition in India itself, I mean, look at the rollout of Geo, for instance. During this period when they got about 200 million people in India, they could do this in 120 days. 120 days to get 200 million, acquire 200 million customers. I mean, they could do it at $1 per customer. That was the acquisition cost. Prior to this, the cost of acquisition in India itself was $25. But the cost of acquisition in America today is about $200. So we've made the cost of acquisition of customer fall from $200 to $1 in India. And that is the big thing in India, that our ability to use technology, our ability to use digital identity. I mean, when I was a young officer, I was working with the traditional fishermen in Kerala. And my job was to transform lives of traditional fishermen. I gave them outboard motors, they could go much further into the sea. I gave them new disco nets, which were then known as disco nets, fishing nets, gave them new crafts. Their production increased, their productivity increased. But fishermen were prone to drinking. And because they live a very topsy-turvy life, they used to drink every night. So my job was then to open their bank accounts. And so that 50% of the money could go into their bank account. Opening a bank account was a nightmare. Chasing physical bank managers, doing know your customer, used to take 7-8 months. Today we do it in less than a minute on a biometric. So what we've demonstrated is a huge ability to technologically pole vault. And that is the big story of India. And I think that transformational work, the building blocks have all been laid. And that is why I think the future is all India. It's all because of the energy and dynamism that young startups have brought in. And that is the big way forward for us. So many people, when you talk about this huge winter of money not flowing in, let me just say that 2021 was an exceptional year when you had about 35 billion flowing in. 2022 as well, you have close to about 26, 27 billion flowing in, and that will continue to flow in. Now, 27 billion is a lot of money, still a lot of money, and I still feel that I'm a great believer that the success stories of Indian startups, those who are well governed, who have a good business model, they will continue to attract a lot of money. And you will soon see a lot of Indian companies, a lot of Indian family businesses, a lot of Indian insurance and pension funds. They will also putting aside money into investing in startups, because you will then have a lot of good startups looking at their governance model, at their business flows. And I don't think money will ever be in short flow for those who have a good business model.
Yes. And now, moving to, we have the building blocks in place, the key foundational elements in the ecosystem, initiated by government infrastructure, propelled by private enterprise on top of that. That movement is on. But the rate at which new emerging technology is coming up, the way new industries that never existed and new powers like AI, blockchain, crypto, space tech, clean energy, etc., the gamut is infinitely vast now. How do we make sure that the Indian entrepreneur leads the charge on this? And from that perspective, as a ecosystem, as a country, what would be, in your mind, the priority areas? Where is the sunshine? Where can India win?
So, Prashant, we are today the fastest growing large economy in the world. We're growing at about 7%. We are the 5th largest economy. We are on track to be the 3rd largest economy by 2030. But it's very important that our emphasis must be on raising our per capita incomes because we are a large population, 1.4 billion people. It's also important to understand that there's a difference between 7% rate of growth. If you grow at 7%, you'll take your per capita income from $3,000. In 2047, you'll take it about to $15,000. If you grow at 8%, you'll take it to about $18,000. If you grow at 9%, you'll take it close to about $24,000. But if you grow at 10%, you'll take your per capita income per head to about close to $32,000. So the compounding power of growth is so enormous, and therefore the passion and the commitment for growth at high rates is very important. We should not settle for anything less than 9 to 10%. I'm saying this because countries like Korea, Taiwan, Singapore, and in recent times China have actually done that 10% growth for a very long period of time. They've done it for almost 2 decades, 10% growth. And why did they do this? And how did they do this? They did this on the back of just 2 things. One is they went in for technology and the sunrise areas of growth. So if you don't go digital, if you don't get into sunrise areas of growth, and to my mind, if you don't go green, it will not be possible for you to grow. Because all the valuation on your ability to attract capital will come in if you are a digital company and if you are going green. That is the future, and if you get into sunrise areas of growth. So when I was structuring the production-linked incentive scheme, my whole focus was focus on sunrise areas of growth. And therefore, the PLI was structured for electric mobility, it was structured for battery storage, it was structured for solar, it was structured for green hydrogen, it was structured for mobile manufacturing. All these are new emerging areas of growth. So my view is that cloud, AI, quantum computing, robotics, drones, opening up space, all these are future areas of growth where a lot of work in terms of liberalization has been done. And I think these are areas which will really propel growth for India. To get the size and scale is important in all these areas. A huge amount of technological disruption is required. India needs to get into deep tech in a very big way, and all these are very important. But there's also a very important area, and that is about going green. And to my mind, the world is going to go green because, we are not responsible for carbonizing the world. At 1.5 degrees centigrade, we occupy, the total carbon space available is 2,800 gigatons. 2,400 gigatons has been occupied by the developed world. We are not responsible for that. But yet, if India is to grow, otherwise we'll all be extinct. India is to grow and expand. We must become the first country in the world to industrialize without carbonizing. And if you do that, the whole world will put money into you and your companies, because it's not that there is a shortage of money. There's a vast amount of resources available. There's a huge amount of resources available with institutional funders, pension funds, who want to put in money, but they want to put in money into those companies which are going green. And therefore, going digital and going green is really the way forward.
Yeah, and see, a lot of sectors, for example, green, I think there's universal agreement that that's where the world needs to be. But when it comes to specifically going after those opportunities, the world also needs to come together from a policy perspective, which I believe is one of the G20 agenda items. Can you talk more about the G20 and why and how does it come together? What exactly does this forum do? And as the leadership this year and as the Sherpa, what are your expectations and aspirations from this year?
So G20 comprises of both the G7, that is the developed world, and the emerging markets. It's important because G20 contributes about 85% of the global GDP. It accounts for about 78% of the global trade. It accounts for about 90% of the patents. It accounts for 2/3 of the world's population. So 90% of the patents, 85% of the global GDP comes from G20, and that's why it's very important. Now, it's important because India's presidency is important because so far, India has always been responding to agenda set by the developed world. This is the first time that an agenda is being set by India for the rest of the world. Whether it's startup, whether it's accelerating the pace of inclusive, resilient growth, whether it's climate action, whether it's sustainable development goals, or whether it's digital transformation. The agenda is being set by India, and others are giving their perspective on that. And our job really is to bring a consensus around many issues, including how to drive startups, how to build the right ecosystem for digital transformation, how to take the Indian narrative of digital transformation to the rest of the world, how to take the Indian narrative of what we've achieved during COVID, of providing 2.2 billion people, 2.2 billion vaccination, which is totally digital, and how we've been able to integrate, become the pharmacy of the world and the vaccine capital of the world, and integrate it with Ayurveda and yoga to the rest of the world. So there's a huge opportunity to push the Indian narrative to the rest of the world. But it's also important to tell the world that, it's very, very important to tell the world that the kind of development that we've achieved, it's not just that we've done digital transformation. Today we do 11x more fast payments, digital fast payment. We do 11x more fast payments than what USA and Europe do together. So you want to understand this. We do 4x more payments than what China does. That's the kind of leapfrogging we've done because we do direct debit credit from the bank rather than going through a wallet. We've been able to build 30 million houses. 30 million houses in the last 8 years. And 30 million houses is like providing a house to every single Australian. And we've been able to build 110 million toilets in India. 110 million toilets means like providing a toilet to every single person of Germany. Every single person of Germany. And we've been able to prove, 243 million citizens have been provided piped water, which is like providing piped water to every single person of Brazil. And we do 500 million people with health insurance scheme, which is totally paperless, cashless, digital. So I can be living in Bihar, moving to Tamil Nadu, I'll carry my health insurance. That's almost twice the population of the United States. We built 55,000 kilometers of highways. 55,000 kilometers of highways is making, 1.5 times the diameter of the earth with complete road. So the size and scale of what India has done is just phenomenal and mind-boggling. I just read it today. There's a paper which has come out from IMF that we've lifted 109 million people from extreme poverty between 2016 to 2022. So what India has achieved in terms of size and scale of the transformation is just mind-boggling and phenomenal. We don't realize it because we're seeing this on a day-to-day basis, but the transformation story of India has been just enormous.
Fantastic. Now, government has been doing a lot of work. Private sector has been doing a lot of work. How can the two work closer together to solve more problems, more challenges? Or do you see it's already happening in a big way? How can startups participate more in the agenda of the government, in the agenda of the country?
So, when we started the Startup India movement, there was a lot of regulatory cholesterol, actually. And, there was so much of regulatory cholesterol that actually we had to find a definition for a startup. The reason why we had to find a definition for a startup was because there were labor laws, there was so much of Inspector Raj that and we had to exempt the startups from everything else. If we hadn't done it, we would have every startup will have an inspector on his door every third day. So we defined startups and we then got a separate order issued saying that no labor law will apply here and therefore no inspector will go there. So there was, since then we've done a lot of work around the ease of doing business, strapped about 1,500 laws, simply because we believe that actually government should only do policy making. The wealth creation is the job of private sector, is the job of young startups. Disruption is your job. Wealth creation is the job of the private sector. And actually government should get out of every single business. And actually the government's job should only be to ensure that we are able to provide better education, better health, better nutrition. But wealth creation, business, taking India forward in terms of being a $35 trillion economy should all be the job of the private sector. So all of you should really disrupt India every single day. All of you should really, do a lot of wealth creation and drive India in all these new areas of growth which we are talking about. That is the way India will grow and prosper. It will not grow and prosper because the government is trying to do business. It will grow and prosper if government keeps getting out of businesses and you people create wealth.
And as we look at government and regulation, especially for new age sectors, one of the key things that the ecosystem looks for is clarity, ease, and a time-bound framing of the regulatory direction. Investors need it, entrepreneurs need it, and all of that. As a government ecosystem, what's the structural reform that is going on to enable some of these things?
So the structural reforms, if you go back, unlike the rest of the world, which Suji spoke about, Europe and America gave a huge package. They brought in so much of liquidity, which has now led to inflation. And because of inflation, you are tightening down and you're raising your interest rates. And as a consequence of this, several banks which have taken deposits from startups and Silicon Valley banks, etc., put their money into US Treasury, and as the interest rates rise, you're facing this challenge because there's an inverse correlationship between interest rates and bonds. And therefore, these banks are suffering because of the rising inflation rates. And the big packages, the root of the crisis is the big packages given by these countries. In India, we didn't give big packages. We brought in radical reforms. You look at the goods and services tax, which subsumed 32 different taxes, all digital. We brought in the insolvency bankruptcy code so that people could fail and get out. And there should be no price for a failure. All of us are bound to fail at some point or the other. And insolvency bankruptcy code takes place that. Many of us who come from a middle class background, we all suffered because of adequate regulation of, from these construction companies, and therefore we brought in the government brought in the regulation, Real Estate Regulation Act. The government redefined the MSMEs, which was pending for almost 3 decades, and actually the corporate tax was brought down to the best rates possible across the world, and therefore a lot of FDI has come in because of the corporate tax being brought down. So a huge amount of reforms have been carried out across the Indian economy. And actually, these reforms are going to pay you in the next 3 decades. These reforms are going to provide a massive impetus to Indian economy as the world slows down, as you feel this huge winter of discontent in many parts of the world. You will see an acceleration of growth in India because of the vast amount of structural reforms that have been carried out, including ease of doing business, including scrapping 1,500 laws, decriminalizing many of them. And I think the way forward is make things easy, and make India the easiest nation to do business in. That is the way forward. Just scrap all rules, regulation, and procedures so that no act should, to my mind, be more than 3 pages. No rules should be more than 2 pages, and no form that you guys fill up should be more than 5 or 6 columns, and it should all be digital. And nobody should have a physical interface with the government. It should all be digital interface, and we should be able to solve all problems of our citizens digitally.
Absolutely amazing. That's the India we all want to build together. That's the India we want to live in, and I think that's well said. It's a funding winter or a winter with challenges all over the world, but it's springtime in India, and we look forward to continuing our endeavors as we build this ecosystem together. Thank you so much, sir, for sparing your time today and coming to Gurgaon all the way for this conference. I know we have a lot of questions, but do we have time to take one or two? We are out. We can maybe take one. I have 30 seconds. The gentleman behind that, please. Have to be very quick. I think you can both speak your questions quickly.
I'm an IT student. I have 10 years of experience in the same industry. We're talking about circular economy and sustainability. I'm building a platform for circular economy and electronics. So what would be your suggestion to promote this faster through the government?
Okay, so and I think I'll take both the questions and then so you can respond.
The startup seed funding scheme, which was notified in January 21, has an eligibility criteria of only 2 years of incorporation. I was wondering if some relaxation could be given so that it can benefit more startups. This is regarding the 20 lakh initial grant and then the 15 lakh marketing debt funding that is given. If that can be considered.
Two questions. Circular economy, what is the potential within the government ecosystem? And second, on the seed funding.
Yeah, so circular economy has got a phenomenal future. You're on the right track, and I think the government is laying a lot of emphasis on circular economy, particularly they've identified about 13 sectors in which electronics is one of them. And I think if you're focusing, you said you're focusing on electronics only? Yeah, so that's the huge amount of potential of doing it in electronics sector because India is making sure that circular economy norms are implemented and the Ministry of Environment has already come out with the rules and regulations on the electronic side of it. Detailed norms of what each sector has to do will be issued across 13 sectors. But circular economy is really the way forward. The Prime Minister himself has laid a lot of emphasis, and both Niti Aayog and Ministry of Environment and Forests have worked together across these sectors. And electronics is a very, very key area in that. So you're on the right track. Any help we can provide you, I'll be very happy to do that. So just send me a mail. And on the seed fund, the intention of that was to pick up startups which have become stable. You have to give them 2 years of time to mature. If you do it too early, but what I'm suggesting is just give me a note, just a one-pager on my No, so just send me a mail. Okay, so just send me a mail. I'll get this examined, and we'll try and find a way out for this. So I'll be very happy to look into this and try and assist you on this.
All right, I think there are lots of questions, but we are unfortunately out of time. Of course, a lot of people would want to ask specific questions, but thank you so much, sir. Personally and on behalf of the startup ecosystem, really grateful for your continued leadership and stewardship of the startup ecosystem here. Thank you.
Because you had some issues, and anybody who wants to send me a mail, it's at amitabh.kant@nic.in. Just send me a mail. If anybody else also who has a challenge or a problem, I'll take it up with the right people, your problems to be solved. So let me just congratulate all the startups who assembled here today and for this tremendous energy and dynamism. And let me also congratulate TiECon Delhi-NCR region for this phenomenal, absolutely phenomenal energy that we did. Congratulations.
ballroom, also know there are parallel sessions happening at Royal Room. The next session in Royal is around the the evolved cloud startup opportunities in a data-driven world, which is powered by Net App Accelerator, and it's happening at Royal Room next. So with that, also would like to quickly thank our sponsors. Google is one of our ecosystem enablers and ecosystem sponsors. So thank you, Google, for that. We thank our gold partners, Microsoft and Sequoia, for their support. We also thank our registrations and access partner, Viva AI. So with that, I'm sure that everybody here in this ballroom right now is looking forward to the next session. Would everybody agree that revenue is vanity, profit is sanity, and cash is reality? Does everybody in the ballroom here agree? How many of us agree that profit is sanity? Startups in the house, is profit sanity for you? So let's hear it on the next panel, the path to profitability, which is powered by Client Associates. And I would like to thank them for their support in getting this session together. Let me now introduce our panelists. It's Mr. Alok Bajpai, who's the Group CEO and co-founder Ixigo, Rohit Sareen, co-founder Client Associates, Ruchi Kalra, co-founder and CFO of Business, Vikram Gupta, founder and managing partner, ID Cap Ventures. And to that, we will have Mr. Chandra R. Shrikant, editor, technology and startups and new economy, money control, to chair the session, please. Can we have a big round of applause for our panelists, please? Get our hands together for our panelists and let's hear it from them on path to profitability.
Hey everyone, good morning. Okay, it's not Mr. Chandra, it's Mr. So I'll just clarify that right at the beginning. But great to be here in New Delhi, and we have a cracker of a panel here. Very good composition to founders of profitable startups, profitable unicorns, and of course we have the investor representation as well. Alok and I were just talking before the session on how many startups, how many unicorns are profitable. While it is a minuscule fraction today, the good news is we have two profitable founders on stage who will tell us about what it takes to chart that path to profitability, and also if profitability is a temporary focus now in the current environment or if it's here to stay. So let me actually start with Vikram. Vikram, if you can give us a perspective. Everybody is talking about a funding winter, a funding crunch, and suddenly profitability has become, the in thing. It's a good thing to talk. So is it a temporary shift in mindset or is it here to stay?
So I think, this whole perception of the profitability becoming in thing now, I think I would slightly disagree with that, especially from an investor's perspective. Profitability is important right from day one. It's just that the startup is not profitable at that time. That's understandable because initially you're focusing on acquiring a market, building a top line, the market size is so large, you want to make sure that before anybody else enters that market, you actually go and acquire a large part of the market. All that requires investments. And therefore, you build capacities towards the future, and you will be making losses in the beginning. But what is important is profitability and the profitability mindset, which means your business has to be such that your gross margins of the business are high, and then the capital efficiency mindset attached to that is very important, that you're actually using the right set of resources, the productivity of the resources is good, you're going after the right markets and not burning just too many tests. Of course, you should be taking risks initially, do certain tests, but you're not taking undesired tests, or risks which are not required at that stage of the business. So I think if you're making losses in the beginning of the business where you're still, capturing some market, it's very natural that you'll be making EBITDA losses. But eventually, profitability mindset is very, very important. And that's the reason, when you're profitable at scale, that's the time when you really see the proof of the pudding that you're actually
In
getting
case
value.
the funding environment changes, will we again see this growth at all costs mindset coming back?
I think there is definitely a huge, I would say you've seen a shift of mindset and it gets driven by the amount of capital available in the market, right? So if you look at 2021, we're talking about COVID led to a lot of money getting printed and getting distributed to people and that money coming back in form of investments and therefore there was more capital available than the demand for capital. So there was naturally, the valuations went up very high. People didn't look too much about the immediate profitability, etc. at that time. As soon as the gears shifted in 2022, obviously people started questioning those very decisions. And now that we're in 2023, I think, and we have this history and experience of this entire cycle which has happened, people have gone back to fundamentals of understanding the basics of the business and does it really make sense to really be in a business that they're investing in. And there have been correction in valuations for the right reasons. We're looking at some data with the US context. We look at the IPO pricing versus the current market caps. Companies are almost at 30% of their IPO pricing, except for a few companies like Airbnb, which was $86 billion at IPO and 74 billion even today. You will look at companies like DoorDash, which is 60 billion at IPO and 20 billion market cap today. So average, you will see about 50% of their IPO pricing, which is now the valuations there. So that correction had to happen, I think, which is good for the ecosystem.
Alok and Ruchi, both of you run profitable firms, and cash flow positive firms is not adjusted EBITDA or whatever new age firms like to call it. I just want to understand: is profitability something that a founder thinks about on day zero? Should they think about profitability on day zero? Should they think about it a year after starting up, 2 years after starting up? How do you sort of build the profitability mindset? Because you can't just wake up one fine day and decide. So what goes into it, and how did you both of you think about it?
So I think I'll agree with what our co-panelists actually brought out. So each stream, every founder starts by thinking how they can create value rather than day one thinking about valuation. Now there could be different businesses which would have a very different story of how to create value, right? Most of us sitting here order differently today, go from one place to the other differently, right? Have a very different way. Most of us have ordered online for most of the dresses we are wearing as well, right? So the way India was 10 years back or 5 years back is different in terms of how we actually do business, how we actually live our individual personal lives. And many of the startups are part of this journey. And that is a bit of the value creation story. Now, in terms of building an enterprise, sometimes it requires huge investments. But as a founder, the thought is always that what is the value creation story for the entity? For us, yes, from day one, we wanted to be profitable because first of all, the space that we are in, B2B, it is something which has to become profitable because it's not that you need to spend a lot of money in acquiring customers. So if we end up spending too much money in acquiring customers to reach our end goal of a revenue number, then we are going wrong in how to create value. However, there are a lot of businesses wherein an initial marketing spend is required, initial framework is required, where you need to do that investment. And hence, yes, that will lead to profitability, but you need to create that base and a structure. It's like building a house, right? Sometimes you build a house and you can put the first floor on rent and keep building the second and the third floors. But sometimes you have to build the full building and then only you can sell it, right? So you need to make an initial investment. For us, because we were in B2B as well as lending. Lending as a business, it's very, very clear in every investor's mind that it needs to make money. You cannot be network eroding. So there are businesses which can, if they are in the right spirit, if they're built with the right thought process and inputs, can reach profitability much faster. But on the other hand, there are businesses which actually will take time to reach that profitability, but to build that scale, they need that investment. But to use the second logic to build the first business type, or to use the second logic that it will come, but having no sight of profitability is wrong. So the third option of having a reason for spending money without seeing how it will generate value is something that all of us should avoid.
Right. Very interesting points. And Ruchi also gave a very granular view of profitability that perhaps B2B lending, those segments lend themselves to profitability more than consumer facing businesses where you have to keep spending to acquire customers. And that's a pattern that we've seen in e-commerce, in edtech, in payments and so on. So Alok, again, do we have to look at this, in a more subjective way? Can there be one playbook for profitability, how founders look at it? Take us through your own experience.
Yeah, so I think in our journey, we were very lucky in the first few years to not get the money easily, right? The first 5 years,
People like myself are not helping you.
well, tried. But the first 5 years, and Ixigo is not the first online travel company in India, right? We already had well-funded incumbents, OTAs, etc. in the space. For the first 5 years, we couldn't raise a Series A, right? In hindsight, that's what built our DNA and muscle. So I think fundamentally profitability and the inclination of thinking in a frugal manner is something that becomes the company DNA. And more important than tough times, it's during the good times how you behave that defines whether that DNA gets built over time. Everybody says, yeah, times are tough, we move towards profitability. But when you raise your next round, are you again going to start spending on things that make zero sense, right? That's when the decision is much harder because the temptation is to go and spend on those things to just show growth. But I think the fact is, if you're not building a company for investors and you're building it for creating some real value, solving a real customer problem, I think what really matters is what is the burn going to fund, right? Is the burn going to fund growth at all costs without a product market fit? Or is it going to create capacity so that you say that when I reach a certain scale, I can be profitable and it's within my control to actually burn only this much to reach there? And I'll give you a small example. Like we raised our round in 2011, the first round, started spending, started trying many things. And soon we realized that, whatever we were spending on some of the paid marketing channels made zero sense. And even though we tried everything, we realized that, look, a lot of these guys just come because you're spending money or you have a discount, and the moment you stop doing that, you don't see any retention on some of those channels. And then you realize that you have to go back to the basics of how you operated when you had zero capital, right? So whether it was doubling down on viral video marketing, whether it was just not adding too many people in the team. We were actually just 100 people for the first 10 years. We didn't cross 100 people in our business, right? And I think forcing that upon yourself and making sacrifices during the tough times, I think as a founder, stepping up and being the first person to say that, look, founders and leadership go down to zero salary. If we have to save the company, we have to do certain things. And those things, build a different mindset among the rest of the team and brings in the resilience required to carry through the tough times. But when the times are good, that's when you've got to put the brakes on, not spending mindfully, right? And because I know that the times will be good again, right? I've seen enough cycles to know this cycle won't last forever. And it's during those times that the DNA will get built. Right now, it's very easy to say, yes, I'm going towards profitability and I'll show it in 3-4 quarters. What do you do when you get your next round? That's what defines it.
But where does that discipline come from to not overindulge during the good times?
No, I think very valid point made, and I could relate it to our journey as well. I think when you have limited capital, then your mindset becomes the same in terms of how do you create value out of that limited capital, and you try to cut small costs here and there, and that it's a matter of DNA. And if that DNA is inculcated upfront, because it's the initial team of 20, 30, 40 people together actually has seen those times, whether it was for us in ILFS or COVID, and through those periods, if you know what's the right thing to do, then that DNA becomes a part of the DNA of the organization, because the DNA of the organization is defined by how, like, the top 25 people are operating in day to day. Like, for example, if I'm asking the same question, people who are working with me are asking the same question. कि भाई margin कम क्यों है? Or the same question, okay, if you net off the operating costs, you'll not, as a business unit, make money. So those conversations become a part of how you are having your daily conversation. It's not like a one-time investor conversation. So that's what defines decision making on a daily basis. So yes, I think a little bit of conserving capital. And for us, the second thing that worked was we always looked at equity as a source of capital. For us, debt was also equally an important source of capital. So you try to build your outcomes or business outcomes in a way that you can attract different types of capital, and that automatically makes you, for example, at our time, a bank would say, I need 3 years financials in green. That became 2 years, right? That was at least a time like 6 years back. And then you're like, okay, if I need to tap debt markets, then this is what are the ratios that people will look for. And hence those become your business outcomes. So I think a combination of the fact that as you grow, you will need different types of capital. Like, for example, we would have 50 lenders on our balance sheet today, right? So that also inculcates discipline. One is more internal, as to what our friend mentioned in terms of saying that how do you build the DNA. Second is, which parts of the external market did you pick up and say that defines the outcomes. I think the question was, will you push for growth and all? There'll be investors saying something, there'll be lenders saying something, there'll be consumers saying something. Which parts of you pick that up and say that this should define what your DNA is. Right? Rohit, what do you want to add?
No, I think I hope everybody is able to hear me. So I think very good point which have been put up, Chandra, by all our fellow panelists, starting with Vikram, Alok, and then Ruchi. I'm very glad this conversation is happening because I can bring a perspective from the public markets point of view. See, and in public markets, there's something we call as a holy grail, which is return on equity. Right? Public markets reward such companies which demonstrate consistently growing their business at very high ROE, return on equity, which is more than 20%. And on the contrary, there are businesses which go out and do buybacks, which they further improve their return on equity. Markets even reward them more. And on the other side, businesses which very frequently visit the markets to raise more capital, public markets punish them. I'm constantly qualifying public markets because private market investors' behavior could be different than public market. So at the end of the day, wealth creation is all about making money on money. So if let us say you've created a market cap of, let us say, 1 billion, and you've raised a capital of 1 billion, that's one thing. And there is another business which has raised a market cap, which is a valuation of 1 billion, and they've raised 100 million. It's a different business altogether. So I think at the end of the day, whether it's a unlisted business or a listed business, the holy grail remains return on equity, and there are brilliant examples on both sides of the game. On one side, as Mr. Kant mentioned about Zerodha, it's a great example. Hugely profitable, growing at a very healthy rate. Similarly, on the public markets, something called Asian Paints. And it's also industry agnostic. If you look at, we say, what tech companies and all, you look at the US, the FANG companies, the good old, they're still the FANG companies, they're hugely profitable. All of them are hugely profitable. And perhaps because of them, 3-4 of them are also sponsors that are sitting at the top. And it's all coming because they are profitable. And if you look at their stock market performance also, in a year like 2022, which was the most difficult year for the US stock market, here in India, we don't realize it, where the Nasdaq lost almost 30-40%. Apple is positive at 2%. And Microsoft is just following in calendar year 22, just 5%. So at the end of the day, the return on equity is a holy grail. Profitability is a holy grail. Whether you are an unlisted business, you are a listed business, whether you're a technology industry, non-technology, anything. So I think that the rules of the game don't change for anybody.
Right. Since you mentioned Zerodha, I should ask you this, Alok. We were just crunching data on profitable unicorns. It just so happens that 23 out of 100 unicorns are profitable, and the top 3 most profitable unicorns are bootstrapped. So there is Zoho, there is Zerodha, and then there is New Sigma, which investors. So is there a direct correlation between profitability and the lack of VC money and investors? Does that spoil discipline?
I think easy access to capital definitely impacts discipline. I mean, we've had our own examples as and when we faced tough times. The inclination to go back and fix the basics and make the business grow organically without needing fresh capital. That's always there for every founder, right? And I think for these three companies that you named, I do believe that it's very tough to imagine building a business without having access to outside capital for so many years and yet reaching an outcome where the profitability is in triple digit, quadruple digit growth, right? And I think for certain consumer internet businesses where the nature of the market is such where a certain amount of money is required just for capacity creation. If you look at e-commerce, right, you need logistics, warehouses, and all that. There is a certain capital requirement. Most internet businesses will have a certain amount of capital requirement. I think it's just hard to imagine how those businesses can get built without any outside capital of any sorts, unless the founders themselves have deep pockets. But I think it's more to do with the discipline that the board and the investors also want to see in these companies. I think we were living in an environment where the VCs were also okay with how things were going, as long as the next round was within sight and the next round was a markup, right? And I think it just creates bad incentives for all the actors, right? Because chasing valuation instead of value creation, right? As a founder or as an investor, that makes zero sense. Because valuation should follow from value creation and not vice versa. So I think it's important to remember what the goal post is. If the goal post is only about raising the next round, the incentive alignment may not be towards profitability, it might be towards growing at all costs, right? Whereas the goal post is around creating a sustainable business. You're okay with lower growth so long as you are actually fixing the basics in the business. So I think it's important to set the right incentives.
Vikram, I'm going to ask you to respond to that. Are VCs hung up more on valuation than value creation? Are they okay as long as the next round is a markup? And secondly, do you think VCs need to be more consistent when it comes to what they expect from their portfolio? Because before this so-called funding winter, there was a pressure to grow, show those numbers. And then in the first sign of trouble, cut your burn, show profitability. So it also brings a lot of pressure on the founders to change that slate overnight. So, these 2 points, if you can weigh in.
So, one needs to understand how the VC model works, to understand that, right? So if I'm a venture capital investor, I've taken somebody else's money. I have promised to that investor that within a time frame, I'm going to return that money. Typically 5 to 6 years is the horizon I look at. And in that time frame, if I'm investing in 20 companies, in every company I'm expecting, let's say I'm going to get a 10x because I'm actually looking for that kind of an exit. There will be failures, so which means some of those companies have to give me much more than 10x, and others maybe 10%, 20% of those will become zero. So in that situation, right? So the VCs tend to look at the businesses which are disruptive in nature, and when the businesses are disruptive in nature, the potential for scale can be exponential, right? So you can actually see exponential growth. Now, if you look at a model like a ChatGPT, for example, if you had the opportunity to invest in ChatGPT today, zero revenue, is there profit today? Absolutely not. But look at the disruption. If you had an opportunity to invest in that as a VC, you would absolutely want to invest in that, because you don't even know, where the revenue is going to be. In fact, the CEO of ChatGPT was asked a question, what's the valuation? He said, we'll ask ChatGPT themselves. So they will answer the question. But the point is that I think from a venture capital perspective, disruption is the key. Disruption brings the potential for exponential growth. Each business that you're investing in, you're looking 5 to 6 year time frame. You're expecting, a substantial value increase happening, and you will have failures, but the ones you succeed in will succeed really well. At IVCAP, we've actually been very, very focused on profitability mindset right from the beginning. That's very important for us because we believe that at the time of exit, when we are looking for a 5 to 6 year exit time frame, either the company should be already profitable if it was not profitable at the time when we invested, or it should have shown the signs to be profitable very soon. at least, from a margins perspective, is a very good story to tell. So that's the kind of thing we need to build, and that's why we keep pushing the founders to achieve what they're out to achieve from the business perspective. So that's how, we see it to be there.
Got it. Rohit, you mentioned how expectations from the public market are starkly different from the private market. And we've seen this play out, when it comes to some of these new age tech company IPOs. All of them are talking about profitability now. But one metric that they keep using is adjusted EBITDA. And there is no standard definition for what is adjusted EBITDA. Everyone adjusts it the way they want to. Do we have to rethink or jump this adjusted EBITDA, go for good old EBITDA? How do you
Go for cash flow.
No, I think very, very interesting, and I would say very important question, Chandra, and thank you for asking it. So first of all, I would say whether it's adjusted EBITDA or EBITDA, good thing is that companies are talking about EBITDA. So let it be adjusted EBITDA. At least they're talking EBITDA is coming into that. But my personal opinion on that is that there's nothing adjusted. There's only one thing which is reality in life. I think those are only creative accounting practices. Reality is profit is profit. Either you have profit or you don't have profit. So I think it will be sooner than better than the reality sinks in. These are very, very brilliant founders, brilliant entrepreneurs. I think their potential is far more, and they're just kind of getting distracted by these small little things. They can create very large businesses. They've already created very large businesses. All they have to do it. They have to think profitability, convert them into a cash-generating machine, and make them possibly the Apples or the Googles of India.
Right. Ruchi and Alok, both of you run, businesses that have reached significant scale today, and I'm sure you're thinking about an IPO at some point. So, what are the one or two things that you want to keep in mind, or the lessons from the 6-7 IPOs that we have seen in the last couple of years? Keep in mind when you are ready to hit the last.
For us, the important thing is we have to continue doing what we are doing. I think that's more important. I heard the word distraction. One should not get distracted, because as a founder from day one, you define some key principles on which you're building the business, right? And for us, those 5-6 principles are very, very crucial, critical, and they still stand. Like, for example, for us, that we will always be net worth accruing, for the fact that we will always take debt and equity together, for us that technology is an enabler for us as we build the business, or for that matter, in terms of saying, are we sales first or marketing first? So there were some principles that we defined. Right? If we continue on those principles, for us, public markets is a new capital source, is a different capital source. For us, we've thought about each capital source in a way that it should be respected. I know a lot is said about investors in terms of how can they give these crazy valuations. But at the end of the day, we have a lot of respect for all investors who rejected us, as well as all investors who came on our cap table, right? Similarly, we have a lot of respect for each of the lenders who's on our balance sheet, whether it's a 5 crore lender, 50 crore, or a 300 crore lender. And I think if we show the same respect for each individual who actually comes and actually invests in the IPO, and showing that respect means that we prepare for it well. We go IPO at the time we think we can deliver as per their expectation. That's for us showing respect. In terms of what they want, whether it's an EBITDA multiple, PAT multiple, or whatever it is, when we think that we are ready to show that respect, so that we can actually, justify why they're putting up money in that company, I think that's when we'll do IPO.
Got it.
I just want to add, based on our interactions with public market investors, what we've understood is that these folks value things like governance, predictability of earnings, and operating leverage. Because internet companies, by definition, you should have operating leverage, right? Like, your margin should improve year on year. And I think for us, the big parameter is that as we grow, as we become more and more profitable, I think it's important to not let the hubris get to our head. We're still a very small company with very small earnings, and there is still a lot to do to earn more trust among our customer base. So I think that's one, and also just to under-promise and over-deliver. That's something all my mentors also tell me, that look, it's very important to not make tall promises which you cannot keep. It's better to say you will grow X% and then deliver more than that. So I think that's very important.
It's a classic Infosys approach. Yeah. You know, we keep talking about unicorns, and that's sort of the desired end state for many startups. But both of you have interesting monikers for startups. I remember Vikram often talks about dragons, and Alok talks about cockroaches. Do you want to tell us about that? You know, we should stop thinking in terms of unicorns. We should think about other creatures. So tell us about dragons and cockroaches.
I think globally people have been celebrating the term unicorn, which is $1 billion valuation. And we all know that, $1 billion valuation is a valuation at one point of time. And that can go up and down. You can be unicorn today, you cannot be unicorn tomorrow. So in our focus, what we look at IVCAP is dragons. What do we mean by dragons? A dragon is a company in your portfolio which gives you more than 1x cash returns on your entire fund. So what does that mean? So we had the first fund with 40 crores. We had one company, Purple, where we had put 15 crores for a 30% stake. We exited that, at 330 crores in one single exit, right? So which actually gave us a dragon exit. So our focus is to actually really create such dragons. And I think that's also in a way looking from a profitability mindset perspective, because eventually we are answerable to our investors. We're also looking at profitability, and we are looking at the portfolio level and trying to create as many dragons as possible.
So good luck with all the dragons. Alok, why cockroach?
Well, I think if you look at cockroaches, right, they
can survive a nuclear.
Yeah, basically, look, they're operating under the radar, can't see them, and they know how to survive in really bad times. Once in a while they can even fly if they want to. But I think the important thing there is just the resilience that creature has, right? Surviving through the toughest of times, if you're able to just keep your head down and keep doing what you're doing. And I think we've been through that not once or twice, but like multiple times where, we didn't know how to pay the salaries for the next month. But being able to figure out a path around that, as a founder, as a team, because the team is obviously also willing to sacrifice during those times and help you get out of it. I think those are times that create cockroaches. While this term is that, I think there has been too much attention about valuation-led terms have an issue that some of those unicorns may not be unicorns today, right? Because ultimately the definition is related to a valuation. But I think what I like about dragon and both cockroach is that end of the day, the aspiration is to create something which is more long-lasting, right? I mean, the companies that actually return these funds are companies that created enough value for someone to come and give cash worth that, and that should be the benchmark. I think that how much cash have you been able to return your investors? I mean, I can tell you proudly that on average for our past investors, we've returned 6 to 8 times of the capital they've invested till date, right? For the ones who've exited. And I think those are the metrics that mean more to me, that we've been able to earn the trust and deliver that as opposed to any valuation gauging.
Great. We have, I think, 7 minutes of closing thoughts from all of you. Ruchi, anything that you want to leave founders with when it comes to profitability, a playbook perhaps, lessons that will serve them well in good times and bad times?
So a couple of things that come to my mind. First is it's great to actually have this discussion. I remember about conversation really long back, 4 or 5 years back, and there used to be always this tussle between growth versus ROI, and in terms of ROA, in terms of what is the return on assets and what's the ROCE is what we just generally track, right? And I think the balance is important. It is not that just because you have to, cut short your journey to profitability means that you have to massively compromise on growth, right? Both of things have to go through a balance. But at the same time, if you don't have line of sight to profitability and it's just a wish or a hope, then it's something that you as a founder should answer upfront as to what is the kind of enterprise that you want to build. Because for us, an enterprise is worth even being called a unicorn or something that outlasts us as founders, right? So that's our philosophy. Will your institution outlast you as an individual. So if you think of it that way, then you need to have that resilience to go through various cycles. Then you need to have cash that is accruing and can be invested back into the business, because if you expand, you need capex and everything else, right? So the institution needs to outlast you. The only way the institution can outlast you is because whether you build in the mechanism that it has the resilience, it is not dependent on individuals, and the fact that it is accruing cash. To do that, I think there needs to be 2-3 different mindsets. Someone who's actually keeping a cash record, in the sense more than generating profit, it's important to also manage cash in the initial journey. So don't lose sight of cash flows. Your business starts with cash flows management. Cash is king. Second is profitability is crucial to say. When you have reached a particular level, then you need to generate that cash from a business perspective. And profitability is not just about expanding margins, it's also about reducing costs. It's also about cross-selling things, it's also about finding newer opportunities. And most importantly, the thing that has worked for us is whatever is not working, shut it down fast. You know, it's like a part of your organ which can actually spoil the full body, so hence you're okay to chop it off. And that as a founder actually helps us.
Very well put, Ruchi. Rohit?
Yeah, I think my parting thought, closing thought on this discussion would be, I've thoroughly enjoyed all the thoughts together, that, profits are the benchmark, they are the foundation for growth. Because if you don't have profits, how will you fund growth? And there are companies which are profitable, but if they're not investing their profits in growth, they don't get a high multiple. So, but there are companies which invest their profits back into the growth, they get a high multiple, and there are many good examples. I've just mentioned about Zerodha and Asian Paints. They're a very good example of, Indigo. They operate in an industry which is highly competitive. Others, find it very difficult to stay profitable. They have remained profitable year in, year out, right? Which means there are two entrepreneurs or maybe half a dozen entrepreneurs in the same industry. Probably one has figured it out how to run a business profitably and also grow it. So they have leading market share with about 56% of the market share, and they're profitable. So at the end of the day,
you don't have to sacrifice one.
You don't have to sacrifice one. Your business model has to be good, and you have to run your business very well. You can get the market share. India is the market to build market share. We have 1.4 billion people. If you won't build market share, where will you build it? So I think that's the way to go.
Yeah, so one tip that I can give all the entrepreneurs in the room, which is very valuable, like about 4 years ago, we started this practice at Ixigo. And as you scale, it becomes more difficult to do this, but we look at daily P&L. So every morning I look at the P&L of the last day to the last rupee, right? And without that, you improve what you measure, basically. We all know that, right? Like without that kind of discipline within the team, within the leadership team, it's very hard to not just achieve but also grow profitability. And similarly for cash flow, right? Like end of the week, we look at the actual cash balances we have and we track that every week, right? So I think just doing that one small thing changed the mindset for the whole team as to what metric are we looking at, why is it important, right? So I think that's something you can do at every scale.
That's amazing. You can improve what you measure.
Yeah, I totally agree with whatever has been said on this. And I think eventually, it's not easy to maintain that discipline. It's very, very important. And one thing which I would still like to say that, despite all this importance of being profitable, I think if you're onto something disruptive, that does require investments. But as long as your mindset is capital efficient, you're not burning cash for unreasonable purposes, etc., I think you can build something which is huge. And for building something huge, you need to invest into the business. But I think one should think of how to evolve with the cockroach mindset into a dragon. So I think eventually that should be the
unicorn list, we start making cockroach lists and dragon lists.
Right. So I think that's I would say.
Great. On that note, thank you all very much, Ruchi, Rohit, Alok, and Vikram. A huge round of applause for all. Thank you very much.
Thank you so much. That was a very insightful session, and we hope that I can present you a small token of appreciation from TiE and from our gifting partners. So please stay on the stage so that we can quickly present to you a token of appreciation and also the book from Papa CJ. Can we have a big round of applause for our panel, please? That's a very insightful session on party profitability. A big round of applause, please. So they say that profit is not to be added at the end, but rather to be planned in the beginning. And that also sets the tone for our next panel. Before that, I would like to quickly thank our innovation partner, AWS, for their support. We would also like to thank our co-partners, Earther, D-Little, You, Christie, and Ankur Capital for the extended support. And for everybody who's looking at the panel sessions that are happening, so this is happening at Royal Room, which is just next, or rather in front of the registration desk. Next session in the Royal Room is a keynote on unraveling sustainable, profitable businesses with Sridhar Rajgopalan. So everybody who's looking at understanding and unraveling sustainable, profitable businesses, Royal Room is where you move to, which is just opposite the registration desk. And with that, I would now like to talk about the next panel. We think about investors. If there was, honestly, let me ask this. Let me throw this question to all of you. If there was a startup ki Kali Kitab which unravels 101 ways to woo your investor, do you think it would be a bestseller? How many think that a book which says 101 ways to woo thy investors would be a bestseller? Okay, not many, I think. So let's actually hear it from the investors themselves. The next session is the Riders of the Storm, which brings to us the investor's perspective. And the profiles that we have are all there in the e-handbook. So everybody who's wanting to understand who the speaker is, please do look at the e-handbook. Let me invite on stage our next panel, Arjun Vedya, Ventures Lead India, World Invest and co-founder at V3 Ventures. Arjun Vedya, I invite you to stage. Please give a big round of applause for Arjun. Next up on stage, I would love to invite Padmaja Rupare, co-founder, Indian Angel Network and founding partner, IAN Fund. The next up we have is Loni Sehgal, founding general partner, Lumitar Fund, Bharat Anand, partner, Kaitan & Co., Saket Kartikaneni, AVP, Chirate Ventures, and Jeevraj Singh Sachar, who would be chairing the session, who's the founder and general partner at ISBC. Can we have a big round of applause for this very interesting panel talking on the investor's perspective?
Hello everyone, I hope all of you are having a lovely morning. Although we're waiting for one of the panelists, I think we'll go ahead and start for the benefit of time. As we get started, firstly I'd like to express a lot of gratitude to be in the presence of some incredible folks here. We have a very diverse panel of ex-founders, very experienced investors, folks with a lot of cross-border experience, global exposure in investing, somebody from a legal background, and somebody reasonably younger who has a lot of portfolio exposure currently considering the times. The idea for the next 40 odd minutes is to uncover and separate the noise in the signal. A lot has been said and done, and I'm sure there was a panel before this on profitability in the current ecosystem and what's the chatter around it. But when it comes to the funding winter, there's so much jargon out there, much of communication, but a lot of lack of substance, I'd say, right? And that's with a caveat that we all know so much, but I want to take this opportunity to clarify much of it. And as we get started, maybe I'll just throw a question broadly, openly to the panel, which is to say that when we think about bear markets and their sort of extremes, how do they actually play out in the business cycles, right? Like, are they a necessary component of what happens, or should they be treated as a shock? Feel free to take this.
Okay, yeah. Look,
happy to go first. Hi everyone, I'm Saloni Sehgal. I'm the founding general partner of Lumikai. So I think with Charlie Munger says that if you invest in, let's say, the markets, there are going to be periods of agony and then there are going to be periods of joy, right? So if you have seen, and as all of us have seen over the last few decades, there has been a severe period of, let's say, market outperformance. Inevitably it is followed by a period of market underperformance, and it is simply because when things don't go well, people become cautious, and when people become cautious, things start to go well, and as they start to go well, people become less and less cautious, and that's a forever cycle, right? And Howard Marks says this. And I think what's ultimately really important is to try and understand the period of the market cycle that we are in currently, especially in the global scenario of what's happening in the funding environment right now. I think markets ups and downs are inevitable. I've been an investor and I've been in the investor space, I've been an entrepreneur, I've been in investment banking and private equity. I have seen through 3 bear runs and bull runs, and I think it's par for the course.
Absolutely. I mean, it's always great to have this reiterated, to understand that this is a part of the natural course and nothing abnormal about it. As we proceed, I think it'll be interesting to understand what's maybe happened in the past, and then maybe come to Padmaja for that. If you can maybe share from your experience as to how bear runs have played out in the past, what your experience has been, and how that plays in comparison to what we're seeing right now.
No, I think what Bhumika says is correct. What goes up comes down, and what comes down goes up. I mean, that's a cycle that we will continue to see. So this is not an unusual cycle. I think there are 2 perspectives to this. From the perspective of entrepreneurs, I think what this is allowing entrepreneurs to build even a much more sustainable business. Cash flows have to run for a longer time. You have to start thinking of unit economics you really have to start thinking how your unit economics are running. Debt starts becoming a little bit more attractive, if your cash flows are running well. I think what it is, and some very good solid foundation companies start emerging, because they are not only emerging when they are in the downside, and to be honest, in the bear markets, you see something called job losses. So excellent talent emerging, right, and creating companies. So I think this is not a bad situation. I think this is a great opportunity to build very good, solid foundation, sustainable businesses, and I would see it like that. For investors, if I look at it from another perspective, we've seen 2008, we've seen 2015, we've seen 23. I think the way I look at it is that good businesses will always be investable, because investors still have their businesses to invest and make money. This is a great time to buy. Valuations are low. Good solid businesses, you have to do a lot more work. I don't deny that, but I think there are great opportunities sitting out there, so it's a good way. I think the issue is really, if I may say so, is that if you are not on a sustainable model kind of a business, then, and relying more on next rounds, that's where the rubber hits the road, right? Because that's a tire burning situation. So all in all, even historically, if you go back, whether in the US or in India, some great companies which are icons today have actually emerged during bear times, right? So I think that this is going to happen. All I can say is, as you grow your business and you gather more experience, every time the markets go up, start planning for the markets that they will go down. So start planning when you are at a high.
Absolutely. I think those are very interesting insights. And while we've gotten multiple perspectives, I'd love to go to the founder plus investor perspective with Arjun as well. Before I do that, I'd love to wake the audience up to the tune that we want to make this very interactive, and I don't want to be the bottleneck here. So we'll take the last 10-15 minutes for a good couple of questions from all of you. So please keep your notepads in run. We will take questions at the end. But as we come to Arjun, since you've gone through that, founder journey yourself, you've seen multiple cycles, and now you're on the other side as an investor. considering that empathy perspective is just way higher, what are you seeing and what can founders do to make out the situation? What do we see there?
Yeah, look, I'll say first, big thank you to TiE Delhi for hosting me here. I've come from Bombay, but I'm loving the energy. And you know, when I talk about energy as well, I sold my business in April 2021. I would say I sold my business at the height of the excitement, right? The D2C wave and all of that happened. And so we sold Dr. Areas in 2021. And that's when I started my journey as an investor. First off angel investing and now running a VC fund as well. And I'll be honest, I drank the Kool-Aid, right? I started thinking to myself that everything that we do in the new age digital economy is the solution to all the world's problems. I come from a traditional family business. I would have dinner table conversation and say, you guys don't get it. Like, this is the way to do it. You just scale so fast that eventually you figure out what the answer to the problem is, right? And so I think from that perspective, that energy allowed or made a lot of us start believing things that weren't real, and I'm guilty of the same as well. Now, when we look at where we are today, and I think we got here sometime in the mid part of last year, while it may seem like a bear market, the reality is I now run a VC fund, but our parent has offices in the US, in Europe, in the UK, and in Southeast Asia. Everyone is most excited about what's happening there. So for context, from 21 and 22, this looks like a bear market, but I went to raise money in 2017, 2018, and I can tell you, we're much better off now than we were then, right? So if I think about founders' empathy perspective, I would say the best thing to do is if you have actually started off or started building in the 21, 22 era, erase some of that. It's easier said than done. But start thinking, as Padmaja said, about sustainability and real business models. Right? You want to ask yourself tough questions which aren't easy to do. And because I had a father who's run a traditional business, I can ask all these tough questions like, you think you're doing so great, but you're burning a lot of money, right? And I think once you ask yourself those tough questions and you put a mirror in front of you and you actually see what will happen over the next 2 years. Am my contribution margin positive? Words like EBITDA and bottom line are being used by investors like us, which we didn't use so much for the last 2 years. I think overall we're in a good place for good businesses, right? And in this market, the difference between good and not so good businesses will be much more stark. But capital is flowing. Investors have raised money that has to be deployed. If I look at India in the perspective of the world, and because we're in India, sometimes we get caught up in what we're seeing just around us. If I look at India in the perspective of the world, we are in a very special place right now. And so, from an empathy perspective to founders, I would say that maybe it's a little bit tougher than it was over the last 2 years, but it's only going to get better.
Just to add a little bit of data perspective to few data nuances to the discussion of ups and downs of business cycles and their impact on funding in India. So we've been doing this analysis and keeping a track of funding trends in India, etc. And it's so evident that cycles go up and down because, like it was mentioned, post 2016, we saw a cycle where immediately after the aftermath of currency fluctuations and the bear market resulted in 2 years of lesser funding rounds and flat years in terms of dollar funding in India. But this was again immediately followed by the best years in terms of funding exits as well as the amount of funding going higher. I think what's very interesting is that during this phase of 2016-17, almost up to March 2018, if you look at the revenues of the startup ecosystem, which we measured by looking at basically audited financials across for venture-backed tech startups, we saw that revenues actually, the annual growth rate of the entire ecosystem sort of decreased in these years. It was roughly about 15% compared to 40% if you look at the average from 2012 to 2020. But immediately post that time, the best years of revenue growth, funding, in terms of number of rounds, in terms of dollar value of funding, everything went up. So I think clearly macro has an impact on the amount of funding as well as revenues. in the Indian startups?
Absolutely. No, I think those are crucial data pointers. And to what Arjun said, I think always long in terms of the ecosystem and long India in the larger scheme of things if we zoom out. But getting a bit more tactical here, right, and coming to Saket perhaps. You've seen the portfolio and we were discussing this off stage. You've been working very closely with the portfolio and understanding what the on-ground reality of companies is right now. Can you maybe shed light to what founders and teams are going through at this point and what can be done from a more strategic lens to navigate the next 12, 18 odd months?
Correct. So I'll start with the flavor of conversations that I'm seeing from founders within our portfolio. There are 2 to 3 positive trends. Number one, I think founders believe this is a time where they can actually focus on building the kind of business that they've always wanted to build. Businesses are a lot more geared towards, especially early stage startups, are a lot more geared towards building versus handling external chaos. From a market where a lot of good talent was being bombarded with offers on their LinkedIns, today founders feel like they can manage a tight ship, retain good talent, and build using the teams that they have. So internally, there's a lot lesser chaos, which gives founders the belief that they can navigate the ship that they're leading very well. If I extend the logic out a little bit, surprisingly enough, in the markets outside as well, the chaos has decreased. We're seeing this especially with SaaS startups in our portfolio, software as a service products that are building from India to other Indian startups or selling to startups outside. And what we're seeing is customer personas in SMBs and enterprises who were bombarded with a lot of offers and a lot of SaaS companies pitching to them, are seeing a lot lesser companies. There is a lot lesser chaos actually in the market outside. By the way, these companies also have lesser spends to invest into these software companies. So again, like people are taking, the decision makers are taking time, having conversations and investing into cost-effective products, which is where Indian SaaS companies are doing very well. We are seeing this, albeit to a much smaller extent with our consumer portfolio as well. Lastly, in terms of growth, which are important conversations between founders and investors in this market, about 90% of our portfolio is organically geared towards, they've pivoted their mindset at least towards building a fundamentally strong business. Now, like it was mentioned, a fundamentally strong business could mean strong unit economics, figuring out your ICPs or figuring out your go-to-market line. In order to ensure that if you have a fundamentally strong business, once you have the cash, you can bet on growth. So I think these are some of the things. What companies are doing, I'll quickly cover. I think one, there are 2-3 companies in our portfolio and across the ecosystem, you will see a few companies who have very little cash and unfortunately their fundraising cycle matches with this down market and they're not yet ready for future investors. In those cases, you take drastic actions. You cut down teams, you fire people. In a lot of other cases, we've seen that down markets are actually good for businesses. They're necessary for businesses to understand if they can actually sell to customers and get the kind of growth in revenues despite the business cycle. And if you don't, you'd much rather correct for that because you want to be business cycle proof. So we're seeing business pivots. And the third category of startups are where they're actually not changing anything. Life's as good as ever and it's actually better for them to build in this market. So tactically we see these companies and these are kinds of actions.
I'll just weigh in on that from a legal regulatory standpoint because obviously our startups are competing for capital with startups all over the world. And therefore, I think it's quite important for the regulatory framework to provide as much support as is possible. Now, in the context of, say, someone who's actually going out there, I think, there's a point made on the panel about, having a hard conversation to begin with yourself and figuring out that, that I need to go and raise capital. What are you going to do? You do a flat round or a down round. And in India, given how the exchange control regulations work, if you're looking at, typically if you do a flat round or a down round, you're looking at a convertible note structure. And typically how that would work is that, you would essentially suppress the fair market value, raise at whatever price, and then ensure that your convertible note converts at a price, which then gives you the arbitrage that you're looking for, based on the future perspective. But with the whole angel tax move that has come about, right, that's just a recipe for getting taxed, because that whole fix no longer works from a tax standpoint, both if you're a domestic AIF or a foreign fund. And querying whether this means that now we need to start looking at FVCI registration across the board, because that's one of the exempt categories, or in whichever pocket this will work out. But I think what's happening is that some of the tools of the trade that are available to deal with this situation, and allow companies to who are prepared to give the higher seniority and the lick pref and whatever coupon on investment amount, things like that. The people who are willing to go through that test, through trial by fire. But still, the tools of the trade are, that way limited in terms of what you can do on the cap table. So I think that's something we need to really think about hard. Just thought I'd weigh in on that.
So I just want to add, I completely agree with Bharat. We are a very confused country. On the one hand, we've sort of liberalized, quote unquote, that FDI in restricted areas sectors can come structure. On the other hand, we've got the angel tax, right? So I personally am also very confused that are we inviting foreign capital or not? But having said that, I think there is a huge opportunity that we are sitting on. Today, as a country, as a startup ecosystem, what we have done is we've created some, and even larger ecosystems beyond startups. We've actually been able to innovate and build things here at a very, very efficient pricing, right? If you look at a couple of things here, for instance, if you look at space, it's a great opportunity, right? Mangalyaan started the trend of building, going out there and competing with NASA and actually building a very capital efficient rocket out there. We have companies like Gurgaon Space who are actually now working for overseas US companies working here, and therefore there is a whole new go-to-market that you can do on the back of talent and capital efficiencies here. That's one. The second is, it is during the down rounds. It is during, the downturn, when the times are tough, that the tough get going. We've heard that before. But I'll give you a live example. When the pandemic hit, and in the first lockdown, we had a company which was into solar panel cleaners, robotic waterways. The company was going nowhere. It would have been shut down on 1st of April. It was that, right? The company, actually the founders turned around and built a ventilator. We as investors created a 20-member task force to support them on Zoom calls for 95 days from 12 to 2 p.m. 7 days a week. They landed with a functional product duly approved by the government and all regulatory bodies, signed up with the public sector unit. In 15 months, they had installations in 3,500 hospitals, right? And their revenues, they laughed at their way to the bank. So when the tough times hit, when you think you can't do anything, you can't even move out of your house, look what companies can do. And this is what I think, what entrepreneurs are, that's the genetics of entrepreneurship, right? That you are nimble, you're able to think disruptively, you're able to grab opportunities. So I think what happens is you actually can innovate when you're under stress and come up even a bigger way. That's where I'd like to leave it. That it's not all doom and desperation and depression. I think there's a lot of opportunities out there, potential. Just pull it out of yourself and you can make it happen. That's what I would say.
I was going to make one more big point, which is that, and I completely agree with Majal. I think there's a lot of opportunity there. But, if you're going and looking for capital, and suddenly you say that, look, the traditional route is drying up, or people are on pause, then you go and speak to corporate venture capital, then you go speak to SWF, right? They're very different animals as investors. And if you have, sort of say you've got some funding lying there, 20, 30, $40 million worth of funding raised, and then you're talking to a very different type of sort of P&L driven, CVC or an SWF, which has a much longer perspective, whereas you've got folks sitting on your cap table that are looking at sooner exit. Those kinds of situations require, in resolving those kind of cap table challenges, which is what we end up doing in terms of our day job, can create struggles, right, and real philosophical challenges. And so I think, for folks who are looking at that aspect, I would just, sort of urge a word of, think about it philosophically, because the philosophies are very different.
Absolutely. And those are all very, very crucial pointers to take note of, and a lot of consensus and interesting perspectives there. We're almost at the halfway mark. To get a quick sense of the room, if you're liking the insights on the panel, can we get a strong yay? Okay, so we have the room active. I'll have two more questions open to the panel, post which we'll come to all of you and we'll have a mic circulating. But I think one of the things, and this is out of pure curiosity, as folks who are in the audience and not in the day-to-day, there's a lot of noise, right? Which is to say that there's, the Gurgaon unfortunate incident that happened, Silicon Valley Bank that happened, something or the other keeps happening. How do you separate that noise and what is that signal, right? Like, what do you eventually believe in and what do you follow when it comes to like on-ground insights?
I'm a little less sanguine than the rest of the panel on this. When we look at macroeconomic perspectives and when you see what that means for, let's say, Indian companies and Indian startups, right? A lot of people have said a Go Mechanic and a Silicon Valley Bank and all of these things have been products of a environment which was, let's say, a zero interest rate regime, right? And we've kind of covered this as to how macro impacts the micro. And that has never been more true, especially in the last 3 years, right? What we saw in the last 3 years, even as an investor, has been a period which was discomforting to, I think, most people in the world, right? It wasn't just about, let's say, a loose monetary policy, which, loosened purse strings, but it was the fact that we went through a black swan event like a pandemic without going through a recession, largely because Western governments decided that they would print a ton of money and they thought that it would have absolutely no consequences. And that is exactly what happened, right, in 2020 and 2021, why we saw the startup boom and why in 2021 we had a unicorn coming nearly every week, was because of the US and largely the Fed, right? And there is much credit to be given to the Fed for our lovely blossoming Indian startup ecosystem. Is because if we look back at the numbers, right, there is a number in the US, it's called margin debt to GDP. It is essentially the number, and it is actually money that the government gives to people or people borrow to invest in the stock market, right? At the peak of the previous crisis, if it was a tech crisis or whether it was a great financial crisis, margin debt to GDP was about 3%. In 2021, margin debt to GDP was 4.5%. What that meant was people invested in meme stocks, people invested in crypto, NFT trading was at an all-time high, startup investing was at an all-time high, investments into PE, VCs were at an all-time high, and that essentially flowed into India, right? A lot of that capital for the very first time flowed into India at a point where it was absolutely record-breaking, right? In 21.
China was also closed.
And also China was closed, exactly, right? So India had about 60 odd billion in 21 and another 40 odd billion in 22. Now, if we were to see what's happening at this moment, is essentially when you print that much money, the economy overheats. So the only way to do that is to tighten interest rates. So a Silicon Valley Bank happened simply because the Fed raised interest rates and ramped it up from near 0 to 5% in a matter of 12 months. So SVB on one side had to pay 5% interest on deposits, but it was actually yielding only 2% on its securities. And when that happens, crisis happens. So this is exactly what is happening in the US. Now, if we were to make parallels and say, okay, well, what does this mean for the hedge fund industry, the PE industry, the VC industry? Essentially, everybody who thought that they could count on an ever-flowing LP capital flow is now going to go back and rethink, right? Because now you have earning much higher yield in less risky assets, which means that capital for private equities dries up. When capital for private equities and VC funds dries up, capital for startups dry up. And that's essentially the change. Now, a lot of Indian startups end up raising money globally, right? Especially the Series B, the Series C, the Series D, and so on and so forth. That is such a major capital gap which is going to emerge over the next 12, 14, 18, 24 months because the US is in a big problem, right?
If you were to, let's say, see what stable state inflation in the US looks like, it's about 2%. It is currently at 6%. So the economy needs to significantly cool off before we can go back to the last 2 years. So now, if you're an Indian startup who's looking to raise these large rounds, seed, pre-seed, Series A, there is still no problem because Indian funds are very well capitalized to be able to support those companies. The problem comes when these companies have to then raise much larger rounds. So where do they go? So now you have a lot of startups going around Middle East. There's a lot more Japanese capital, a lot more Korean capital, etc., which is coming into the market. But the situation now is going to be, what is that alternative source of capital which is going to now help these companies grow? And I believe there is going to be a significant gap over the next 2 years or so. And how do startups and Indian companies, especially who've been incubated in the last 2 years, who feel there's a constant gap of money, what does that do to founders? And I think those are going to be critical questions.
That's, I think, a very, very interesting summary of the entire landscape and gives us clarity on macro and how the US environment impacts India. Since due to the paucity of time, we'll come to questions now. Instead of doing questions and then question, answer, we'll take all questions at once, which will be about 3, 4. So whoever has one, please raise your hand, we'll come to you. And then we'll leave the floor open to answer whoever is relevant. So go ahead. I see one hand. Can I request a mic to get circulated to the hands in the room?
Hi. Question for everybody. Like, as the winter of investment is a autumn of investors, because in the last couple of years we have seen a lot of investors. Every type of investors are coming up in India, like angel investor, VC investors. So more investors, less investment. How is it? A lot of bad fund, good fund kind of thing is happening.
We'll get to that. Thank you for that question. Yes.
Hi, this question is for Bharat specifically. Considering very SaaS companies and Series B and others, certain organizations split their structure more to get funds from US. What are your thoughts on this going forward?
Awesome. Thanks for that question.
Hi, I have this for everyone. So what kind of trends or environment do you think exists right now for EdTech funding?
Perfect. We'll take one more. Can we get to this part of the audience? Yes.
Hi, thank you. So I'm sharing a founder's problem here. The question is for Arjun specifically, since he has been into D2C a lot. So be it any form of business, be it a manufacturing product, be it a bottle, be it a food product, there's a certain scale at which you can get good gross margins, right? So how do we phase it out? Like, for instance, I'm doing a 50 lakhs MRR currently. I know that I'll make good margins at 5 CR and I'll be a bit positive. So how do I phase it out in terms of my fundraise, in terms of my planning? So that is something.
Got it. Thank you. We'll probably do equals. We have 5 panelists. We'll do one more question. Do we have another hand in the audience? Okay, maybe not. So just to summarize for the benefit of everyone, we have one question on the overall environment and how the funding winter overall, does it mean a boom for investors and does that matter? We have specific questions for Arjun and Bharat, and we have a general question more on the EdTech side, right? Please feel free to proceed as you like.
Yeah, maybe the first question, right? And I think it's an interesting question. I would say that there's 2 types of investors that you were talking about. You're talking about angel investors and you're talking about institutional capital. Now, institutional capital is a longer cycle, right? Because if you raise a fund in 2020 or 21 or 22, you will take 2, 3, 4 years to deploy that capital. And so even if there is a winter of investment, at some point you've taken money to deploy that capital. So that capital that's been raised may be more cautiously deployed, maybe deployed at lower valuations, maybe deployed in different types of businesses or structures, but that capital will be deployed. Now, if you look at the other sort of part of investment you're talking about, which is the angel investment, right? I think over the last 2 or 3 years, we saw an unprecedented rise of people investing in this asset class. But the reality is that this asset class is very, very different from a listed equity. And the biggest difference, right, other than the success rate, the chance of failure, etc., is this asset class is completely illiquid or illiquid for a very, very long period of time. And so lots of people who ended up doing 2, 3, 4 startup investments in a very hot market, and then when the market cooled off, realized there's no liquidity for any of this stock that they would have to wait for a very long time, went away, right? And so I think from the angel standpoint, and I had lots of people who are not from our ecosystem, including my aunt who said, just take my money, put it wherever you're putting it and see what happens, etc. And you know, if I talk to my dad as well, I would say there will be lots more caution and a lot more reduction in this capital level. So that's how I look at sort of what you said, very interesting, which is the winter of funding and autumn of investing.
If you like,
So I'll just add to what Arjun said, to be honest. I think irrespective of upturns or downturns, this asset class, investing either as an angel or through a VC, when you invest in very early stage, it is given that it's a very, very risky investment, irrespective of structure. Number two is that you should only, and I say this to a lot of investors and I'm saying it, is that only invest what is disposable wealth. Something that is not going to impact your lifestyle, your children's lifestyle, education, none of that, and you can sleep peacefully. You don't need to call either the fund manager or the company and says, "Is hafte kya hua?" That doesn't work because young companies take a much longer time. The gestation periods are much higher. Number three, I think because it's so risky, I think the investment thesis is not on what rewards you can get. If you're building a portfolio on the basis of what's your risk mitigation strategy, I think then the returns work better. And there's also constant, after 3 years or so, constant return of money coming in. So investing in one company and saying I'm an angel, I'm taking a very extreme example. If you invest in one company and say I'm an angel investor, honestly that's extremely high risk. So create a risk mitigation strategy across sectors, across companies, across geographies, co-invest, do angel groups investment, you're leveraging each other's competencies and understanding. So I think it's very important in early stage overall to develop your investment thesis on a risk mitigation strategy than a return strategy. If the companies are giving returns, I think the credit goes to the founders. But if the portfolio is giving you returns, then the credit goes to the investor. That's how I look at it. So, if that helps.
I can quickly take the question on the flip structure. To my mind, clearly, point number one is that the rules now allow it, so you can set up a flip structure without worrying about things like round tripping and those technicalities. The hard question you have to ask yourself is why are you doing it? Is this a personal lifestyle choice because you want to relocate, or is it because your business is of a nature that can't get funded in India? I think a lot of the people who implemented flip structures, at least under the earlier regime, have come back into India for exit purposes or are looking at restructuring to come back. A couple of other points. I think one is that look, to my mind, if you are going abroad and you want to run a foreign cap table, you have to reconcile with the fact that the governance is based on what is par for the course in the Valley or in the West, where founders don't stay as founders of the company right until IPO. I mean, I think unless you're Bill Gates or Steve Jobs or someone, it's a very different expectation setting. So mentally, are you in that frame of mind? So I think those are the hard questions that you really need to ask yourself in terms of why do you really want to do it? Stop there.
I can take the EdTech question. Look, I think in EdTech at the moment, it's obviously had a really tough time, right? Existing EdTech companies have been plagued by very high costs, and obviously they've also been able to unit economics, and proving out those unit economics has been a challenge. So if you are a new age EdTech company who's looking to build, I think there are two things to demonstrate here. One is to be able to really show positive LTV CACs in a meaningful way that can get investors interested in the fact that this is a venture outcome. And the second is to have some degree of product innovation as well as a very well thought out distribution strategy of what you're going to do differently, especially with respect to the incumbents and what you're going to do differently from incumbents, because there have been a lot of lessons that are there to be learned. We very recently backed a company called Supernova, and they're essentially overcoming the high LTV CAC problem, the high manpower cost problem by having a gaming native pedagogy, which is tech based, extremely scalable, and they're using now generative AI to really bring down costs. So they're able to have very low cost outcomes and at a very reasonable price point, reaching to a very high volume of users. And the way they've done it has been very differently, because they've been able to showcase both product innovation and an alteration in the distribution strategy. So, if you are approaching a sector which is highly capitalized with very large incumbents, it is going to be quite imperative to be able to showcase how you're differentiated from what's currently out there in the market.
Awesome. Thank you. Last question to Arjun that was directed.
Yeah, I think interesting question. I'll tell you how I used to help founders think about it, right? At Dr. Vaidya's, other than our brand business, I used to run a factory. And so at 25, I got those lessons of running a factory, cost, raw material pricing, etc. all of that. We started a business line in contract manufacturing or third-party manufacturing with the sole objective to help early-stage founders who don't get any years when they have no MOQs. Now, the way I would plan it, the way I suggest you look at it as well is, go to your manufacturer or manufacturing partner and say, today I'm buying 2,000 units. And usually our first order from these startups is 1,000 or 2,000 units. But we would give them costing for 5, 10 and 20,000 units. So we would do 2x, 5x and 10x what they are buying from us upfront, so that they could also understand that today I am getting this product from this supplier at 35-40% gross margin, but that's not real because I don't have scale. And when I have scales, you look like 60, 70, 80% gross margin, which was real in our space of health and wellness products, right? If you are able to actually get that data, then you're able to plan the future of your business better. Having said that, I would say operating at really low gross margins and hope this in the long term will not work. Look, the reality is in B2C brands, we are running P&L businesses, right? If your contribution margin negative, it went on for a little bit of time, but it's not real, right? And so even at the low MOQ, at least aim to break even on your first order and make money on your second order. And then sort of head office costs, other branding costs, marketing costs, eventually you will have to break even and make money. But we are P&L businesses. As consumer brands and consumer businesses, we cannot hide away from those. And we have to live in that paradigm. So these things can help you, but still think P&L. It's really important.
Lovely. Great. I think that concludes the questions from the audience. We still have a minute exactly, so maybe we'll do something interesting. I'll ask you a question. I'm happy to, but we'll take leverage of the fact that all 5 of you are here. Maybe to end, one sentiment for the next 12-18 months, one thing that you are expecting for the 12-18 months, and one question that you are trying to answer in the next 12-18 months. We'll end with those ones. Each of you, please feel free to go in any order you'd like.
So I think the next 12-18 months, what I'm expecting is some great startups to be born, honestly, because new opportunities have emerged. We've had almost 3 black swan events, or at least 2.5, pandemic, Ukraine, and the US is already in the midst of it. So I think these are opportunities if one looks for it. There are new opportunities. Pandemic clearly opened up the digital space. Ukraine opened up semiconductor chips in India. So I think I'm really expecting some interesting startups to come up. And that's what excites me, to see those coming up. And now we have 1,000 crore fund with I'm Alpha, so I'm itching to write checks, if I may say so. The second piece is what I'm expecting a lot of our portfolio companies and what we are advising them. Daily dashboard and cash flow, literally, right? You have to make the money run further and longer. We invest in early stage startups, and that's why I'm coming from that perspective. You will have a problem raising money for the next 12, 18 months. It's not going to be easy. But I also believe, and we are working very, very hard on that, that our companies are not only solid foundation, but they are well, compliance is done, good governance, good teams, and we're trying to build that so that 12 months down the line, they're able to raise monies at good valuations. But cash flow, cash flow, cash flow is all we're telling them. And keep your head down, do the Sherpa work, and get it there.
I'll keep it really short. Two sentiments. One, I'm long on India, so stay hungry, stay foolish. And the second one, head down, cut the noise, and keep building. And the question I'm actually excited to see the answer of over the next 5 years or maybe decade is how mainstream startups are going to get and the startup ecosystem is going to get.
Yeah, I think for me, the sentiment is be greedy when others are foolish, and be be greedy when others are fearful, and be fearful when others are greedy. And I think this is a great time for that. The question that I'm hoping to see play out is the India digital monetization story, where we start seeing digital spends really go through the roof, and really see people spending a lot more on, India's been plagued by this of Indians don't pay, and India is a low ARPU market, and that's that story I'm hoping to see over the next 2-3 years unfold.
I'll just maybe talk about what I'm hopeful about rather than my sentiments. I'm hopeful that there'll be better governance. This is a great opportunity to think about that and implement that and better internal control. And the second is maturity on the negotiation table. I think there's got to be some expectation management and maturity as we resolve problems. I think all problems that people have spoken about potentially are resolvable.
I think the emotion for me is that's going to be important for founders is resilience and the ability to be flexible. And the question that I have in my mind, very similar to what Saloni said, is if the India internet opportunity is beyond payments and beyond maybe scrolling through videos, can it extend to beyond the 50 to 100 million Indians that actively are monetizing?
Awesome. That was lovely. We ended with a quite amazing insights. Can we have a huge round of applause for the panelists?
Hello. Yeah, I just wanted to say one last thing. Thank you, Jivraj, for always being an amazing moderator. It was a really great session. I won't have been the same without you. Round of applause for Jivraj, please.
That was an incredibly insightful session from these panelists. And with that, we'd love to felicitate you with our gifting partners, gifts from Natural Company. Please accept that, and thank you, Basna, for felicitating our panel. Can we again give it up for this incredibly insightful panel, please? With that, I would also love to quickly thank our co-partners, TiECon Company, Indus Law, and Chirate Ventures for their support, and our investor partner, IEN Fund for their support. So there's also another panel session going on in the Royal Room, which is just opposite the registration desk. Also, please know there is a booth outside which has books from our charter members. Do check them out. And also, just so that you know, we will be slightly delayed with our lunch, but then you're always being fed with incredible insights here from this fabulous panel. And the next one is something that I am very passionate about, because being a women entrepreneur, something that I look forward to is many more women entrepreneurs. And we have next on stage a panel which will talk about creating 10x women entrepreneurs. Are we excited about seeing women as entrepreneurs? Can we hear it from the crowd to have many more women as entrepreneurs? And with that, we launch the Women Entrepreneurship Report. But first, let me please bring on stage and invite Srikanth Sastry, President Delhi-NCR, and Chairman ICT Advisory Network, and talk about the report presentation. Yes, you can please give it up for Srikanth. A big round of applause for Srikanth before we hear from him about the report presentation.
Yeah, so I'm not going to make any boring announcements. I'm going to set the ball rolling for the discussion on women entrepreneurs. But here's the curveball. We talk about demographic dividend, but I'm going to start by talking about my mother and mother-in-law. Those were the first two women entrepreneurs that I encountered in my life. And in many ways, they were the inspiration for my own journey as a serial entrepreneur. They were both excellent math and physics teachers who taught dozens of school kids with patience, empathy, and humor. When I watched them in action, it gave me strength, built my own temperament. And I'm willing to place a bet. If they'd been around in today's generation, I bet they'd have built a large tech company because they were far more enterprising than their poor husbands. And today, I'm super excited because Delhi-NCR, Zeno, Google, NetApp, Indian Angel Network, we all came together to look at the contribution of women founders to the Indian startup ecosystem and figure out where the opportunities lie to accelerate them. Let me start with a very silly question. Please don't beat me up for it, but I'll answer the question myself as well. Why do we need more women founders? The answer, one simple answer is women account for 50% of buyers of products and services. And if you leave it to men to design those products and services, you'll never get the kind of products and services women want to buy. So to me, that's one simple enough reason, a very practical reason enough to say we need more women entrepreneurs. Without that, we're not going to make headway at all. So with that silly question out of the way, let me dive into 5 significant findings from a report about women entrepreneurship. The first finding, and someone will need to give me the clicker, please. Right. So while we wait for them to put the presentation up, let me start talking in any case in the interest of time. The first finding was that women are as successful as men in running. So women are as successful as men in running a startup. Their odds of success are similar. Look at this chart. 7 out of 1,000 women-founded startups reached the later stage. The number for men was similar, 8 out of 1,000. Quite simply, women are as successful as men in running a startup. So that's the first bit of good news. The second bit of good news is, if you look at the unicorns in India, we have 17 unicorns, where at least one of the founders is a woman, which collectively raised $12 billion of equity. So they're able to create unicorns, they're able to raise a lot of money, and that's the second bit of good news. The third one is, a lot of people say women don't want to start deep tech startups. Not true. Women founders are not scared of deep tech. When I travel around the country mentoring entrepreneurs at incubators, I meet lots of excellent women-founded startups that are absolutely deep tech. Machine learning, IoT, biotech, vision sectors, healthcare, agri-tech, fintech. So you can see on this chart that a comparable percentage of men-led and women-led startups are leveraging deep technology. The other bit of good news, women as inventors. We said, okay, fine, we're working in deep technology, but are you doing fundamental new products and technologies which are truly inventive in nature? Look at this once again. Similar percentage of women are inventive as are the men. So lots of good news. So many women founders are creating successful startups. They're pushing the boundaries of deep technology and they're being inventive. So that's the case. What's going wrong? There are only 18% of startups that have women founders. Why is that number not increasing? It's been stagnant over the past decade. And they want And you might say they don't want to be entrepreneurs. Not true. Look at this chart. Women have a high intent of starting up and becoming an entrepreneur. It's a slightly higher percentage than men. So they want to be entrepreneurs, they're very good at it, they make a success of it, they leverage technology well. So what's holding them back? And we decided to do a bit of a deep dive, and that's not on the slide, that will be the topic of the panel discussion, but let me give you a sneak peek. The biggest thing we found was that the family and society support that's required to give shape to that entrepreneurial dream, that turns out to be the single biggest factor, and that is a topic that we should discuss in the panel when it comes up. So those were the highlights of the report. And what I'd like to say is that a full report, which is going to be unveiled shortly and is available on the website, has all the details, all the recommendations for what's holding back women entrepreneurship and what's required to change that. And I hope you enjoy the discussion that happens after this. Have a wonderful day. Have a wonderful rest of the day. With that, I'd like to get the rest of the panelists up here to continue the discussion.
Thank you, Shrikant, for setting the tone for this panel. Let me quickly invite on stage our esteemed panelists. Let me start by inviting Apur Chamaria, Head of Startups at VC Google India. Can we clap for him, please? Next on stage, I'd like to invite Padmaja Ruparel, co-founder, IAN, and founding partner, IAN Fund. Padmaja, thank you for coming over. Please can we have a big round of applause. Ravi Chabria, Managing Director, NetApp India. I would love to have you on stage, sir. And the panel will be moderated by none other than Adit Dana, Partner and Head, Zenov. Can you please give it up for this esteemed panel, please? And yes, I am missing on one panelist, my bad. Let me invite on stage Anuja Dhawan, co-founder, Duckverse. Anuja, I'm very delighted to have you on stage. And now that the panel is complete, please give a big round of applause before we begin this panel.
So, thank you so much, everyone. I think you have a big responsibility. It's an important topic, but we also have people, staying away from their lunch. I would say we're going to balance both the things out today, right? Women entrepreneurs, women founders is a topic, we have been discussing for a long time. It's a topic we need to discuss for multiple reasons. Shrikant, I'll get the bottom from what you had said, right? We have women entrepreneurs at about 17 to 18% of the ecosystem. However, it seems that for a couple of years now, it's been very stagnant percentage, right? That percentage pool has not really increased. What is the reason? Right? Is it even possible to reach 50%? I know it's important, but why is it so stagnant?
I think all of us who are in this room are partly responsible because we're very obsessed by technology and entrepreneurship. For some reason, we continue to believe that entrepreneurship equals technology. A lot of women want to be entrepreneurs, but may not want to be building a tech product. They want to do a variety of other businesses, and somehow we've not addressed those needs by supporting them. That's reason number one. Reason number two is there are areas where women are already, now come to technology, women are already there in large numbers in academic institutions. Biosciences is one great example. Large number of students in biosciences and masters and PhDs. Have we worked with them to say, look, you're doing great work as part of your research, can that be converted into an invention and a product? I think we need to focus on specialized sectors like those where women are already doing cutting edge work. So two reasons.
Anuba, what's your take on the subject?
So basically, being a part of the startup ecosystem for about 10 years now, what I really think is that it's a problem of more women need the founding team, right? So if you look at these successful startups around, where have they come out of are these bigger mafia groups, right? Flipkart mafias, PayPal mafia, you see all of those. But if you look at the founding team, there are zero women founders is what I would say. Hence the ripple effect of whatever these successful startups create is not being carried forward. So I believe that's one of the major problems, that we do not have enough women working as founding member teams. Now, why that's the problem is a broader perspective of lesser females in the workspace, lesser female ready to take those risks out there, and there's a more societal things, and definitely I think the whole society has to sort of come together to make that number better.
I want to touch upon the societal piece of it, right? In terms of women want to be entrepreneurs and see actually higher than men, right? One is society, one is maybe personal also. You know, given the insight that you have had, the fact that you've also been building an organization like Ambience, what's your take? Like, how big is the society, this behavior piece to it?
You know, I think that the way I look at it, I would echo to some extent what Shrikant said, that we look at women in either who are building tech companies or who are building fundable companies. I think there is a large number of entrepreneurs, women entrepreneurs out there. And if you go even penetrate deeper into tier 2, tier 3, these women entrepreneurs are doing Soho businesses, or they're building small home businesses, and they are almost the mainstay of running homes. Right? So I think there are women entrepreneurs out there, but we've never really looked at them. We're constantly looking at them from a fundamental perspective. So I think that's one piece. The second piece, I think, which is to echo what she's saying, that while there are Flipkart and PayPal, I think we as women have not come out and created our own mafias or our own groups in some ways, right? I think we are sort of head down. Just as a woman myself, I mean, I'm head down trying to do what I need to do, keep one day to the next day. But have we really built, and I think that's a failure, right? To have built a circle of women around us so that we can share, we can learn, it becomes a support system and create more women entrepreneurs, right? Create that. So I think that's a big issue. But what is really also important that in our society, it is largely a patriarchal society. Even in tier 1 mentally, I see that, right? And if you try and say, okay, we're going to change that, that's going to take forever, right? How do you leverage that is what is important. And that is where the problem lies, that you have too many battles to actually fight. You have the home, you have children, you have your business, you have cultures to manage. So I think that's the big issue that you're fighting all the time.
If I can just add to that, I think building on what Padmaja said, if I put it in simple terms, I think men like me and our generation are absolutely useless when it came to helping out at home. If you take my own example, my wife actually became an entrepreneur before I did. But in reality, she had to shoulder the responsibility at home, and therefore that took a hit. And whereas I was kind of focused on the business, so the day people like me stop becoming useless and become more useful at home, I think some things will change. But I'm hopeful, because if you look at my son, my older son, he lives in the US, but he's the one who cooks. But unfortunately, his wife doesn't want to become an entrepreneur. So otherwise, you would have seen an entrepreneur.
But let me, Shrikant always is like this, let me say. But I think if I know somebody who mentors women, it's him. Irrespective, of gender, I've seen actually Shrikant do it. I think what it really says is something else. I think just as we keep saying this, that behind every successful man there is a successful woman, there is a woman behind him. Actually, behind one successful woman, there are many men. You have mentors, you have partners, you have spouses, you have children. They all have to pick up their little bits. They even give and support, encourage, and that's how it comes. Because a woman has multiple roles. Whether we like it or not, they have multiple roles to play. And if each one picks up those roles, or at least participates in that, I think it goes a long way. So I think I want to use this opportunity to actually thank the many men who've actually supported women who've taken a step ahead in life. So thank you.
So I don't want to take up time, but I want to say the reason I mentor women now, it's my way of doing prayership. Because I was useless with my generation, at least I can make up for it by mentoring women now. So my prayership.
I think I'd add to that, wherein real life example is what I would say. So definitely whatever I'm able to do and to push harder is because of the partners and the extended family that I have. So that really allows you to do a lot more than what you would have done otherwise.
Absolutely, I think we all need our ecosystems, and there's one extreme point Anuja, that you brought up, right, in terms of the fact that a lot of entrepreneurs today are coming from other startups, right? So one of the things which this report found out was that a significant work experience, right? And Ravi, I want to bring you in here in terms. There seems to be a similar pattern in terms of, say, the workforce. Women in STEM is increasing. Women in STEM workforce has been very consistent from percentage perspective. So, what's your take as an enabler, as an opportunity ecosystem?
As I was reading a brief of the report, the parallels are very clear. Look at the women that enter STEM jobs in companies like ours. The numbers are very high, 38%. I date myself. My first job was at Sun Microsystems when we had kind of introduced this Spark Station 1 built out Solaris. I remember somebody coming in and telling me, I want to thank you and all your countrymen. This is in Silicon Valley, because you brought women into the computing workforce. So India did make a difference, but that said, the numbers are bleak. And they're not just bleak, I think, in the accelerator business, they are also bleak in corporates. And there's many reasons for it. And I think a lot of them are mentioned in the report. A lot of these, I think, Advaja, as you point out, they're generational issues also. And I'll say this, there's a lot of techniques you apply to it, but I think at the core of it, you have to understand that not just as a society in India, but as maybe as a vertical business. Actually, it's not even a vertical. As business, I think, it's very male dominated. Very male dominated even today. And you have to understand that. So, some of the techniques you might apply, you may get the token woman in for an interview. I don't know it's going to pay off. Apurva is going to talk about techniques they use in Google. I won't take that from it. But I'll also tell you this, that if you have someone being assessed by all men, you're being assessed by the same lens. Okay? I'll give you a real example. I used to drop my son to school when he was 5 years old. I was the one who at one point dropped him off to the daycare when he was 8 months old in California. You didn't have the luxury of a nanny or a mother-in-law that could take care of people. The thing is, I didn't feel as guilty as my wife did. And when my wife did it and I did it, people didn't spend the rest of the year talking about me doing it. But they sure as hell did talk about my wife doing it. She comes in 20 minutes late every day because of this. So these are very deep-rooted biases, and I think you have to hit it from that angle. Very clear.
Fair point. So, as a you want to add to that, what's your take with that? So we spoke about ecosystem, we spoke about different topics, different areas to focus on. We spoke about the role of the family, as individual in terms of enabling someone on their dreams. Of course, the inbuilt bias in the system, which sort of slows things down. But as an investor, as Chai charter member, what have you seen? What's impacting the top of the fund? Why are we not going beyond that 18%?
So, my personal experience as an angel investor, 40% of my portfolio is actually women founders. And I would love to be more, not from an AI or women make really insanely awesome entrepreneurs. They've always had it tough, right? School, college, workforce, the conviction they have and the purity of purpose they have when they start something and the detail orientation they have is phenomenal. And most of my exits have come from women entrepreneurs. Okay. So
that's a good one.
Huge call out to all investors out there. So I keep asking everybody, I said, including my portfolio companies that introduce me to more, they will build sounder businesses, they will build deeper businesses, they'll be very upfront, candid, they will never oversell it. So I think as investors in this room and as a founders, recruit more women as co-founders, invest in more women, mentor more women, and fundamentally what Amitabh was talking about in the morning, 33,000 per capita GDP, we will reach sooner than later.
What about you, just if I might do your job a little bit, I think you have to look harder for the women founders. Do you make an extra effort?
I don't make an extra effort because if you see wins, you automatically prioritize that. Initially, it started as a thesis that 50% of the workforce is women, and no investor is proactively looking at it. So it was like a blue ocean. So I was one of the early ones to develop a thesis in backend, started getting incredible results, so I doubled down.
So you were looking for it. You figured that's a thing. I think that
some theses don't play out, this plays out well.
So I think what Apurva said is a good reason for optimism. There's one more reason I think we should be optimistic. When I went to IIT many decades ago, we had 2 girls in a batch of 250. It was disappointing for another set of reasons at that point of time. But we went for a reunion 3 weeks ago. The percentage is up to 25 to 30%. So when 3 to 5 years down the line, when this workforce looks at entrepreneurship as a possibility, that percentage has already gone down.
So I would actually add for one more reason why women entrepreneurs should be there. See, women are actually the purchasers. They are the consumers, right? They're doing most of the purchases in the market, right? So they understand what to buy. They know what they need. They have they understand problems. So certain class of products is completely women oriented, right? The best person to build a company is those who feel the pain, those who know the need. So I think irrespective of gender, I would say that just purely because they are the purchasers, they're the best guys to build a business. And having said that, what really irks me today is, and we are young as an investing, right, early stage investing country, especially angels, less than 1% are women. So, that is something which is even more stark. That why do we have such few women investing, right? And in one way, you say the number of women entrepreneurs who succeeded are a fraction, right? And so many of them coming back is only a fraction of a fraction. But the reality is, if we don't have more women investors, we will continue to have certain biases that will remain.
Absolutely.
Especially for women-focused products, for femtech products. It needs women investors. I think that's something we need to also.
That ties in well with Ravi's point earlier also in terms of the corporate. I think
I'm again going to ask a question on your behalf because here's what happens in the corporate. When you decide that you're not getting enough women candidates, you mandate it. People don't like quotas, but I think there is a reality that you need enough of a panel. You can do that even for an interview panel you set up. How do you do that for investors? Though? That's I think a tough one.
Very difficult. So what we've tried to do in a different ecosystem, we've tried to create a group of women private equity players. So while we are sort of creating talent, but we are hoping as they grow and as their careers grow, they get into the investing business and start doing it. But as angel investors, pulling them out is very difficult, right? Many of them don't even have control on the family office monies, right?
Correct.
So I think those issues still.
I have a suggestion. If you will make a commitment, I'm willing to make another commitment. Why don't we commit that Indian Angel Network will run a program only to train women to become angel investors? If you make that commitment, I'll make another commitment. I do programs on how to pitch to investors, storytelling programs. I commit to create a similar cohort only for women. So is that a deal?
And I think that's an awesome thing. If you look at what we did with our Accelerate Her program, people think we were trying to create opportunity for just women. We were trying to create opportunity for entrepreneurs inside the company. They needed to see role models, right? Nurturing them and creating them. I think you have to just flip this cycle of, you have to prove yourself if you're a woman, or you're proven if you're a man. And there's so many anecdotes, the report mentions to it too. You witness it every day. Yesterday, there was a woman engineer in our team who talked about, well, I'm not exactly sure I'm ready. You talk to 10 women, 10 men, they are like 10% of their preparation, and they already think they can do the job after that, right? So it's on my journey. It makes me VP by the time I'm 35.
Perfect. So I think I do want to end the panel right now because we have a partnership here and we should end on a high, but I still have one more question. So we spoke of top of the funnel. The second question is again similar, right? 80% women founders, 10% other funding. First question, is that even the right metric to chase? If it is the right metric, then how does one solve for it? What has your experience been? I'll use that to first. Yeah.
So, I'm not going to be a complex answer, right? Perhaps because I'm a woman. So, I think as an investor, as a VC, I would say yes. That is something that needs to be solved. We need to have more women entrepreneurs, and you already heard a lot of reasons that we discussed. But if I look at it from a different lens, I think that's not a good enough parameter because we are not talking about fundamental entrepreneurs or businesses.
Right.
We're talking about women entrepreneurs building businesses, right? And therefore, we have to widen the parameter, we have to widen the framework so that more women come in and build businesses, which also has new challenges that need to be sorted. For example, bank, debt, grant, building, how do you build companies, how do you bring all of that? It cannot be an all-women company also, gender diversity will be required. So I think there are new challenges, but I do believe that the framework for women entrepreneurs has to be wider beyond funding. So I would love if it's...
Yeah. So I'm going to say that when the room is full of investors and engineers who like numbers, I would say in this case, ignore the numbers. Partly because numbers are how you measure them. If you measure how many women founders among tech entrepreneurs, you get a low number. How many women entrepreneurs in India's population at large, you get a larger number. So forget the numbers. Instead, let's follow Bhagavad Gita's principle, Kar Karo, Bhal Aayega. Let's agree do all the things that we agreed upon today.
Karam karna pad raha hai. I think you have to do it. If I look at it even in the corporate environment, if you measure something, you will do something about it. And fundamentally, if you look at the world out there being 50-50 and you look at anything else that's not 50-50, you come up with a logical reason for why it is. And there's a bias at the bottom of it or there's a system at the bottom of it that needs to be fixed. You can't start with the premise women don't want it. Yeah, you can't. So once you come up with that, you just have to unravel it one step at a time. And the number will get to 50-50. It has to, otherwise something else is wrong.
Yeah, so definitely that's one of the ways to look at it, one of the number definitely. But eventually what really matters is the capital, right? With companies are going bigger, is going with capital. So that cannot, in my opinion, be left behind and said that they will catch up or there are other important things that are being done. So again, I think it's more personal from that standpoint. It's not that every business is built to become a billion-dollar company. They can solve for a wider problem, they can solve for masses, and maybe not just focus on the valuation, if I may. So that's more of a personal choice, but I think from more top to bottom approach, it's definitely about capital, and that's an enabler, right? That I am able to do more because there is a backing that I have, there's somebody who's validating my idea, and I can go further with it. So definitely, I think an important metric to track for at least the top people to make sure that they're able to improve it year on year and get more people and enable more female founders.
So at least what I'm gathering is it's always good to have a metric because it's easier to align people. But to Pamela's point also, the metric can always evolve. It's something we keep discovering. For now, that 50-50 on the funding, for now is a good enough thing for us to chase now because why not? Kind of it, right? But there's a lot more to this whole business in terms of solving for success, right? Overall. I just want to get into your experiences real quick, right? Just 5 more minutes, right? What's worked, what's not worked as you try to solve this problem? Can you give an example? All of you. I just want to sort of understand what's your perspective been in terms of what worked for you when someone tried to help or when you asked for help and what did?
Ask for help.
Also, you got help, yeah.
Sure. No, it has always worked out is what I would say. In this last 1.5 year of journey, I think wherever we are today is because of the community and the support that we get. Google has been a brilliant partner. There are other people in the ecosystem. We have our angel investors who sort of support us along the way. I would not say that just because I'm a female founder, that I think the startup community within India is very, very strong, and they are more than willing to do if you are asking for directed help, right? If you just go out and say, run my business, that's not possible. But if you're going out with a directed question, I think you definitely get that help from the people who've done it, people who arrived in life in a certain way. So I think Indian ecosystem is the place to be at from a startup standpoint. Being a female, I definitely see that additional nudge sometimes that they really want us to succeed, and I see that happening, and I'm happy that I'm in the right place at the right time. So making the most out of it.
Ravi, how about you? Speaking for the accelerator as well as for the corporation, when you look at the number of women startup founders we have, or even if you look at the number of women leaders we have, it's a journey. It is starting. And I think in the last 2 to 3 years, it looks like qualitatively there is a difference in that process. Not just that it's driven from the top down, but I think there is a belief that we are not doing right if we don't get to a bigger, better number.
Got it.
I think when I started, it was difficult. Let me be very honest. It wasn't easy. Even getting up and speaking was a challenge, to be honest. But I think what really worked for me was people nudged me, supported, pushed to an extent. And I think that was necessary, which I didn't see at that time, but I think it's very important. And I think what also worked is have faith in people around you, right? If you have faith and just let yourself go and allow yourself to go with the wave, I think that works. And if I look at today's women founders, I think there is a lot more confidence, there's a lot more gravitas, if I may use the word, as they build young companies. But I think what's still missing is that element of networking, that element of being able to share. And that's why I think a woman mafia is a good idea.
You're definitely in for a mafia for sure.
If I may add to that, like I think that's more of how we are brought up in at least in Indian ecosystem, right? So that really needs to change not at just a corporate level, but maybe at the childhood level. That's more of schooling because we are always more protected in a certain way that don't talk to this person, don't go out alone, so on and so forth. And I think that somewhere gets so deeply rooted that I can't go out and do it. But once you break that barrier, obviously, I think the community that we have here is open enough to accept you in a certain way. But it's more our mental barriers in a certain way that we
opening up and trusting.
What I've seen really work very well for women founders in my back and also my active portfolio is they're very okay being imperfect. I see more women aiming for perfection than men. I think men know they want to, and they're not going to get there. Women want a perfect product, a perfect team, a perfect cap table. Many things, right? They're very thoughtful and deliberate, which can be incredible strength, but as an entrepreneur, it can slow you down. As investors and entrepreneurs, we always straddle the world between not knowing and not knowing at all. So even when we due diligence a deal or we speak to a founder, so to all the women entrepreneurs out there, just get super comfortable not knowing and not being perfect and revel in your imperfection. And that's going to take you.
I think I agree with both Padmaja and Atul. Networking, an area that a lot of women founders feel comfortable with. His point about striving for perfection, famous saying, great is the enemy of good, that plays out here. Often pragmatism required in an ambiguous environment. But what works for women is the makeup for both of these things by working very, very, very hard. I've been fortunate that in both my ventures, I have women co-founders who work very hard, make my life simple, and the business is good.
I agree with you. I mean, my team, which has worked on this report, has been all women team, and I will celebrate, on the same level.
If we can get both the Divyas and Niharika to stand up. So, big round of applause for all three of them. I can tell you they've pulled many all-nighters. They've challenged all the status quo. Fantastic work done.
And on that note, ladies and gentlemen, we'll not keep you from the lunch. There's a full report which is being released. I'll request the panelists to maybe, help sort of highlight the report to everybody here. It's going to be available for download from today afternoon, post-lunch onwards. Please have a look. And everybody here on the stage contributed a lot to making this possible. Thank you so much, everyone. Thank you.
Thank you so much for launching that report, and I'd like to please request the panelists to please stay on the stage and allow us to felicitate you with gifts from our gifting partners, Natural Company. And can we please have a big round of applause for our panelists for this very candid and phenomenal session, which has quite a few questions rolling on the stage, which I, as an entrepreneur, can't look forward to enough. Thank you so much. And we won't keep you away from lunch. Lunch, though, will be just for 30 minutes because we have another super important and super interesting session just after lunch. And for everybody here, do not stop tweeting, do not stop putting your stories out on social media. Do not forget to tag TiECon Delhi, and do not forget to use the hashtag TiECon Delhi 2023. Also, let me quickly thank our partners, CKP Memorial Section partner, Deloitte for their support. We thank our inclusion partner, VSET for their support, and our mentoring in motion partner, Plug and Carson for their support. Also, big thank you to partners, India Angel Network and IDCAT Ventures for the support. Thank you so much, and we now break for a quick lunch, 30 minutes, and we'll be back.
मिल गया भी मिल गया ना